Another day in paradise. Today is Monday. What is it? 28th? I lost track. 27th? Whatever. Another crazy day in the markets. It's up, it's down. Who knows? Trying to call this market on a day-to-day basis, as we know, is a fool's errand. I think trying to get the trend right is the best we can do. It's every day it's another adventure. All they want to talk about today is Elon Musk and Twitter and blah 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 blah. That's a shiny object that's distracting everybody's attention from what's really going on. And I, over the weekend, had a really good conversation with Albert Saporta, who was in this room a couple weeks ago. He put out a masterful deck. I did a call with him. I'll put up some of the charts later. But I I came away from the call independently before the call, and he had the same. He raised the same rhetorical question. I think I mentioned it in the room the other day. Like, what's the bull case? What's the credible bull case? I look at the market. We're coming through a period of record increase in interest rates. Equities are actually more expensive now relative to bonds than they were, a few weeks ago. So Tina is dead. Goldilocks is dead. The economy's slowing. Margin. This is all my opinion. Do your own work. Economy's slowing. Margins will come under pressure. Estimates are too high. PEs are going to go down. The Fed will raise rates until they break something. So take your pick. If they don't do enough, and so far it seems to me they're just talking the talk, they're not really walking the walk, the bond market's going to continue to call BS on them, and rates will continue to rise, and that's not good. Or alternatively, if they actually follow through and something breaks, well, and we get a recession. We have Michael Howell in the room on Saturday, and he was calling for a recession, actually, and he thinks the market's got another 20% to fall. Take your pick. Heads, you lose. I don't even want to say tails, you don't lose. Tails, you lose also. So I just have a really hard time, and someone's got to stop me before I slip my wrist. I just incredibly bearish. The last couple of days, I got schmeiced in some of the energy stocks. We've got a very special guest today, Chris Verrone. He's going to talk about some of those. He's had a very hot hand. But all right, so a couple of days I got clipped a little bit. Well, is what it is. You got to stay focused on the big picture. And so I don't know. I think again, equities continue, in my view, to represent return-free risk. And we talked about this over the weekend. We saw 2 weeks of totaling over $30 billion of fund outflows, coming on the heels of $1 trillion of inflows the last couple of years. And I tell you, one of the things that really pisses me off, and maybe Chris, I don't know if you look at sentiment much, and maybe you can speak to it, but I'm sick and tired of all these amateur technicians at home. They think they know sentiment. And I go back to the Walter Deemer line. It's not when people turn bearish that counts. It's when they're done selling. And so I just think the setup here is just awful. Just awful. And I fully expect that markets will be considerably lower in the coming months ahead. Path, how we get there, who knows? But, if it's all too confusing or too bearish, just be in cash. Keep it, really reduce it to its simplest form. As Dennis Gartman would say, do more of what's working and less of what's not working. If it gets to the point where they're even cracking the leadership, which is the energy stocks, I think they're fine. Hasn't felt too good the last couple of days. But, on energy and on interest rates, consider this. We've had the Chinese, lockdown over COVID. And, all right, crude is bouncing around, but it still went out at 99.04 right now. And the bond yield, the 10-year, is still at 282. Normally, in other markets, if you had COVID crackdown and you had in the market getting destroyed, the equity market getting destroyed like it is, you'd expect yields to be much, much lower. I think the high on the yield was 297 or 298 the other day. So yields are hardly down. Those come off, but that was off of a peak high. So I guess for $50 in double jeopardy, the question that occurs to me is, when this China, as and when and if and when this Chinese COVID concern recedes, just think of the counterfactual. Where are interest rates and oil likely to go? And then you look at the dollar, which continues to be a complete wrecking ball. Michael Howell spoke to this on Saturday, a new local high, 101.72. So the unholy trinity, the triple demerit scenario, the converse of what the Japanese spoke about in the 80s, whereby you had falling rates, falling oil price, and a falling dollar as being the foundation for a big bull market. In Japan, you now have rising rates, a rising dollar, and rising oil prices. And where I come from, that's unambiguously negative for risk assets. So enough of that. You didn't come here to listen to me, and I didn't mean to bias the witness. We're very privileged to have Chris Verrone here today. Chris is a friend of a lot of us in the room. He is head of macro and technical research for Strategas, and he shared his deck with me over the weekend, and again, his updated piece this morning. It's really interesting stuff. So, Chris, great time to be in March. It's a great time to be alive, as they say. A great time to be alive. So, why don't you just hit us with some wisdom? You have a lot of friends in the room here, and so this is going to be a great session. And Chris, take it wherever you want, and we'll the room will degenerate into Q&A before too long. So why don't you just have a go at it, free form, go wherever you want with it, Chris.
So let me tell you a couple things. Well, George, first of all, thanks for having me. I've always been a long admirer of yours, so it's nice to do this and share ideas. And as I always say at the top of every meeting or every dinner or every event I do, there's one thing I know, it's that I don't know. And I don't want to forget that here, because it's very tempting to go into this dogmatic view of what I think is going to happen and tell you all the reasons why. And I'll do that, but I want to go into that with the lowered expectation is I know, don't know. And I know no one else in this room knows either. So we'll do our best. We'll tell you what we're thinking. But like anything, reserve the right to change our view as the facts change. And I've always tried to think of my work, George, as really doing three things. I would say number one, and this is the easiest part, it's to be as provocative as possible. And I think in this market, it's not difficult to be provocative. There's a lot of things going on that we haven't seen in certainly 20 or 30 years. I think the second most important part of my work is to try to be correct. I will break the news to you. I'm probably no more right or wrong than anyone else. But again, I try to do things pragmatically, not dogmatically. And I humbly will and gladly concede the market is a better economist and a better strategist than I ever will be. So let's just listen. And then lastly, and I think this has been particularly on display over the last couple of years, as we've kind of worked through this COVID thing, just be so aware of where the consensus is. And that's kind of where I want to start today, because I think, and George, you alluded to it, I think there is this gaping divide between what people tell me they're doing with their money and then actually what the data would suggest they are doing with their money. I thought you made a good point. We've had some pretty big like spider and triple Q outflows over the last couple of weeks after $1 trillion of inflows over the last 2 years. So I think when you look at flows adjusted for the degree of inflows we've seen over the last several years, I don't think the outflow is particularly contrarian, certainly not at this point. And I mean, how many meetings have we all been in, or how many phone calls have we all been on the last couple of weeks where someone has showed us the AAII survey, right? 15% bulls, I think it was last week, or 20% the week before that. I don't know. I'm not sure I buy that. And I don't think I buy that because when I go into accounts and talk to investors, institutional investors, I still don't come away from the sense that people have sold their Google or sold their Amazon or sold their Microsoft or they're selling their Apple here. I don't get the sense any of that actual selling has happened. So from a sentiment perspective, and I know everyone likes to talk about sentiment, everyone has anecdotes. I don't think the data that measures what people are actually doing with their money reflects the data that says or that suggests what people say they're doing with the money. And at the end of the day, I'll always follow the data that measures what people are actually doing with their money. And I just don't think that's bearish here. I don't think that's contrarian yet. It may get to that point at some point down the road. I don't think we're there here. So that's number one. Difficult time kind of reconciling words and actions. I don't think people's actions I don't think you can make a contrarian call from that. And look at things like put calls. I think it was February 24th, whatever that first S&P low was a few weeks ago. I remember writing to clients that said, listen, this is either the first low of my career where we're not going to get a spike in put calls, where we're not going to get VIX above 40, where we're not going to get a trim reading above 2.5 or 3, or very simply, it's not a low. And that's kind of how I lean here. We'll see what these next couple of weeks bring. I think it's important, certainly every week, if not every 2 weeks, reassess your call, right? Do all the puzzle pieces still fit? And I kind of go into this week still with the directional bearish bias. I think at a minimum, there have been so much individual trend damage with important stocks. I think at a minimum, there's significant repair time in front of us. I think more realistically, there's probably lower lows in front of us. So, one thing that I've talked a lot about, George, is this idea that to resurrect a bull market, to resurrect a trend, you need undeniable and unmistakable momentum off low, right? Go back, we have this data going back maybe 70, 75 years, looking at just on any given day, the percent of stocks with a 2 standard deviation advance, right? When you're coming off a low, you're going to get 50, 60, 70% of stocks on any given day, giving you that 2 sigma signal. We haven't had one of those days since this market tried to bottom in late February. So again, I go back to the idea. This is either the first low in our careers where none of this stuff is going to happen, or I think more realistically, not a low. I'm struck by the fact that for the tech sector, which is now given back, if you look at tech equally weighted has given back every ounce of alpha generated post-COVID. I'm struck by the fact that I don't get the sense that the vanillas, the long onlys, have really moved on from the sector. And frankly, my sense is some of the selling in energy and commodities the last couple of days is more of like the long only who's too long growth, who chased some energy the last couple of weeks and now needs to puke it to finance the Googles that are breaking down, or the Facebook that has broken down, or the Amazon that I think will break down next. So I just get the sense that you have some very weak hands puke energy over the last couple days. I think at the end of the day, we want to own stuff that's in uptrends. For me, that remains energy, basic materials, some resource stocks, some REITs, some staples, some youths. Are they overbought here? Yes, but I don't want to confuse overbought with overowned. When I look at energy, there was a point a couple weeks ago where the energy sector got to something like 35 or 40% above its 200-day moving average. That only happened one other time in history. I think it was November of 1980. And that was, of course, the blow off then in energy, but with one big distinction, right? Energy was, I think, 37% of the S&P then. And today we stand at energy's 4% of the S&P. You may remember this, George. Energy was actually 40% of the growth index in early 1980. It's about 35 basis points of the growth index today. So what a reminder that nothing in this business is permanent. Everything changes.
Yeah.
Energy was 40% of the growth index in early 1980.
Yeah, Curtis, I have to interrupt for 1 second. It reminds me of a funny story. When I started my career at Fidelity, I was a summer intern in 1980. It was one guy, Paul Stuka, and I started. He came from Harvard. I came from Wharton. They took one guy each year, and they gave Stuka the emerging. It was the hot energy stocks. It was like the cool E&Ps, and I was really jealous because I got stuck with like non-ferrous metals or something like that. And I remember it so well. And then I remember the contrarian in the shop, Leo Dworsky, may he rest in peace, just passed away the other year, writing memos about what a large percentage of market cap the S&P was of the index and so on and so forth. So, yeah, the market. There's nothing new under the sun. The last shall be first, and the first shall be last. So I just wanted to butt in because it just brought back old memories. But so Chris wanted to. Sorry to interrupt you. Why don't you just keep going?
Yeah, it's funny. I think we all have a proclivity to believe things will exist into perpetuity, and the second you start doing that, I can assure you the world's about to change. We've all probably have seen the slide. I know we do it. I think some others probably do it. Of look at the 10 largest stocks at the end of every decade. They're very rarely, at the top of that list a decade later. I just think we forget that. there was a point as recently as 10 years ago, the software group was only 2% of the S&P. It got as high as 14% a couple months ago, right? Nothing happens into perpetuity in this business. I think energy at 4% of the S&P is still cheap. The 50-year mean's about 12%. I don't even think it needs to get there. Let's split the difference. Let's say it goes to 8 or 9. Might be overbought here. It might be correcting, but it's not overowned. And I feel very strongly with the idea that we all work in a business where virtue chases performance, not the other way around. And you're already seeing it. You're already seeing the chorus of ESG trying to find ways to justify owning traditional energy. I think we're going to see more of that. I think it's going to be used as the justification to get involved there. A few other things on my mind, and then we can talk about anything. But I remember a mentor of mine used to always say, Chris, all you need to know is what's on the 52-week high list and what's on the 52-week low list. So show me those two lists, and we can figure out what type of market that we're in. I mean, look at the stocks over the last month that have populated the 52-week low list. It's brokers, it's banks, it's discretionary, it's tech. I mean, that's not the 52-week low list that I want. Conversely, look at the stocks that have populated the 52-week high list over the last month. We know it's largely been energy, it's been some resources, but it's been Utes, staples, pharma. I think the most generous description of this market we can give is still very split. I think the more realistic description of this market that we can offer is, at a minimum, it's very late cycle. But when I see banks on the 52-week low list, discretionary on the 52-week low list, tech on the 52-week low list, I don't think that sends the most convincing message about where we are and where we might be headed. You know, when I think back to the early days of COVID, I was lucky to have a good call kind of coming off the lows, April, May, June of 2020. One of the reasons we were as bullish as we were was very simply, for as pessimistic as the world was, discretionary kept outperforming staples. Like every single day, you were getting like 50 to 100 bips of equal weight discretionary over equal weight staples. And that persisted and persisted and persisted day after day, April, May, June, August of 2020, despite all the pessimism around us. It's the opposite today. You know, I kind of always considered that relationship, discretionary versus staples, as one of the best economists on Wall Street or one of the best strategists on Wall Street. That went out last week at new lows. You know, even today, like it bounced, but you're 24 hours removed from a 52-week low in the discretionary versus staples relationship. You could say the same thing about high beta versus low beta, or banks versus utilities, or banks versus gold, right? All these things we look at to gauge risk appetite, I still think are at best tepid, maybe at worst suggestive of a message where we have lower lows in front of us. I've broken this market up into 3 different categories. We've talked for the last year about the baby fangs. You know, those are the ARCs and the IPOs. The second leg of that stool, the 3-legged stool, were what I call the almost fangs, right? These are the NVIDIAs and the PayPals and the Salesforce and the Adobes, names that as recently as 6 months ago, George, were people were talking about them in the same breath or the same conversation as you would talk about the real fangs. And then, of course, that brings us to the real fangs, right? The Facebooks, the Microsofts, go on, so on and so forth. The baby fangs, as we all know, were shot 14 months ago. Maybe that first decline, it wasn't clear whether or not it was a start of a top or not, but certainly by the third and fourth quarter, it became very, very clear that the ARCs and the baby fangs and the IPOs had put in a major top. When I look at the almost fangs today, right, those Salesforce, Adobes, Nows, Workdays, Teams, NVIDIAs, these are the stocks I think people are still holding on hope that there's, say, valuation support, right? They're down 30 to 40%. They're cheap here, Chris. I struggle with that. And I struggle with that because I don't remember anyone telling me they were expensive 6 months ago, number one. Number two, everyone uses this phrase valuation support. I don't remember anyone telling me about valuation resistance 6 months ago. And then I think third, particularly some of these semis, I think people forget that we're dealing with a very cyclical group. And pre-QE, down 20 or 25, or even down 30, was not a terribly deep correction for a cyclical group. I'm always reminded about that 95 to 2000 period. It was the best 5-year stretch for semis ever. They went up, I think, 1,400%, the Sox did. And you had to sit through two 50% drawdowns along the way. Semis are cyclical. When they correct, they don't go down 20 or 25. That was the QE experience. When they correct, they go down 40 or 50 or worse. I think we're in the middle of that with semis right now. I don't think it tells you anything about whether we're going into recession or not going into recession. Frankly, I don't care. What I care about is the history of cyclical declines, and cyclical groups like semis. Down 20 or down 25 is historically not enough when you step outside of that QE regime that we've been in. And then lastly, I mean, the original things. I mean, certainly two of them are gone, right? Facebook was shot. I don't think we'll see Facebook leadership for years. Netflix certainly shot. I mean, Netflix is such a reminder that the worst bear markets happen in bear markets, right? Netflix was in a bear market going into last week, a decisive bear market, and it got worse. Google, I think, is on the ropes. Obviously, they report this week. We'll see what happens. I'd be very skeptical being long stocks with downward sloping 200-day moving averages or in vulnerable positions into earnings. Microsoft, they're starting to get to. Apple, we'll see if we get a little stay of execution this week. Apple, I suspect, will go last. It's been the prettiest girl the entire time. We'll see ultimately, but I would suspect that has to go at some point. So when I look at kind of the three legs of the growth trade, the baby fangs, the almost fangs, and the real fangs, I mean, one by one, they've shot these over the last 14 months. And it reminds me, George, of how the Nifty 50 was treated in the early 70s. I was always under the impression that kind of your Nifty 50 stocks, IBM, Procter & Gamble, so on and so forth, McDonald's, I was always under the impression that like someone rang a bell in January of 73 and they all topped on the same day. But that's not what happened. When you look at the trajectory of those stocks in the early 70s, they peaked one by one over the course of about 2 years, despite company fundamentals only getting better. Wow, that sounds familiar to what's playing out right now. These FANG or FANG-like names. One or two last points, and then I'd love to hear from the group and take any questions. I think we have to be very careful that we don't take the bait on seductive narratives. There are so many seductive narratives out there that are always born out of exogenous events. I mean, remember back in the early days of COVID, right? One of the seductive narratives that kind of came from that was, COVID's not going to change anything, George. It's just going to accelerate the trends that are already in place. Remember that? That was a very popular view across the street. Well, it was a popular view because it was a convenient view for people. Because the trends it accelerated were the trends in the stocks that everyone already owned going into COVID, right? People went into COVID long growth. That was, I know S&P went down 35. The big growths did not go down 35. They outperformed on the way down. They outperformed on the way out. So that, COVID doesn't change anything. It just reaccelerates what was already in place. It was a very convenient view. Why do we not hear that this time around when it comes to energy or basic materials, right? Energy and basic materials was in a bull market for 12 months at least heading into Russia-Ukraine. Why are people not making the case, Russia-Ukraine's not going to change anything. It's just going to accelerate the trends already in place. We don't hear that today because it's an inconvenient view, because no one owns, at least in any size or at least in any magnitude, no one owns that type of stuff. So I always found like these seductive narratives tend to be very convenient narratives, and they tend to kind of be driven by positioning. Another seductive narrative that came out of COVID that frankly I think never really worked was this idea of reopen. I mean, the irony is that the reopen stocks worked when everything was closed, like those first 2, 3, 4, 5 months. Basically, since then, the reopen trade has been a very unfulfilling yet seductive temptress. How many times have we all been tempted by airlines or cruises tempting, but they really haven't worked. I'm just reminded, when you're in the storm, when you're at the scene of the crime, when you're the guilty party, it's a cycle before your leadership can. I mean, think about tech, right? Tech was at the scene of the crime, obviously, in 2001, 02. Didn't really outperform again until 8-9 years later. Banks, we know the example of banks, in 08, 09, at the scene of the crime, really didn't outperform again for 9, 10 years later. Why should we think some of these quote reopen names should be any different? They were at the scene of the accident. I'm skeptical of their ability to really reemerge as
So,
some great leadership as most people want.
Chris, that was just masterful. And just listening, I was just closing my eyes, just listening to you talk for a while. I just listened to the constituent parts of what you say, the pieces that you offer up, and I add them up block by block. And if I didn't know any better, it sums to the idea that the market's completely mitigated disaster. I mean, rallies continue to get sold. The volume is bigger on the down days than the up days. There's bad breath. We're getting a series of lower lows and lower highs. Like, if you just put the narrative aside and trade what you see, not what you think, which is what I really love about technical analysis in purest form, you would just say, this looks bad. And I guess the question I put to you, calling for a crash is a fool's errand. It rarely happens. But markets crash from oversold
Yeah,
conditions.
exactly.
And I would just ask you, in your career, you've seen a lot of markets, and I'm not putting a gun to your head and say, call it a crash, call it a crash. No, 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 no. I'm just saying, like, if I were to ask you, Chris, like, what's the kind of setup you would look for if you wanted the market to take a complete dirt nap? Like, would it really be any different than what we're looking at right now?
I suspect one difference might be credit would probably have to be worse. Like you think about credit, like post Lehman was a crash. I would say that the 3 or 4 weeks of the worst of COVID was probably crash like. 62, right, was crash like around Bay of Pigs. 87 was crash like. I don't know what conditions or what boxes need to be checked for that to be the base case, but I think it's an irrelevant question because I think we're trend followers. I think you're a trend follower, and the trend is down, right? So I think one of the conditions that right, I said about Netflix, right? I think Netflix is a reminder to all of us that the worst bear markets happen in bear markets, right? Netflix was a crash last week. Facebook was a crash 4 weeks ago. Those were stocks that were already in bear markets going into whatever event caused that carnage. So that I think is the bigger takeaway. People, I'll just say this, George, from my meetings the last few weeks. I think people are afraid to use the B word, the bear market word. I think people are afraid to use it. I think that's also very reflective of kind of the sentiment environment that we're dealing with here. It was funny.
Amen.
I woke up this morning.
Go ahead.
I woke up this morning. And I was thinking about I forget who said it. It may have been like Soros or Drunken, one of those guys. It was always like, crashes start on Thursdays. They start with reversals on Thursdays. Had a reversal on Thursday. We had a terrible down day Friday, and the way they opened up this morning. Now little stay of execution here, kind of in this 4,200 range. I mean, I could see this market, give it another shot at 4,400, 4,450. And I think the hardest part of operating in downtrends is patience, because these things take longer to play out than I think we're accustomed to. But I do think the trend is down. I think rallies should largely be sold. I'm reminded of something my mother would always say. We would, she'd take me to the beach as a kid, and like on a rough day or a choppy day, she'd always say, stay where I can see you, right? And I feel that way about my positions right now. I want to see everything in front of me. I cannot get over my skis here because the trend is down. Things that look like they're starting to roll again right now. Look at some of this Europe. Look at some of the Europe stuff. Some of the Europe stuff starting to fall or starting to roll again right here. In particular, some of these European luxury good stocks. LVMH, Hermes, Montclair, Richemont, Burberry. These are little baby top formations in much bigger top formations, right? What do we know about downtrends? You you tend to put these little baby tops in part of the larger topping process. You have that on all those European luxury names here. They rallied hard for about 6 weeks. Those rallies expired about 3 weeks ago. They now have these little topping patterns. Those are all names I think are very, very timely on the short side.
That's excellent. So, Chris, just stay there. I know we're going to have a lot of questions. Mm-hmm. So let's first start off. Good friend of the room, our good friend, Mr. Thomas Thornton. And then following Tommy, we'll have Mark Newman. So, Tom, the floor is yours.
Hey, guys. Hey, George. Hey, Chris. How are you?
Hey, Tom.
That was really fantastic. Well put. One thing, I followed Chris a long time, and we're friends. I will say that he is a very even-keeled technician. He is absolutely one of my favorites on the street. Comes up with brilliant thematic ideas, and I think this is the seriousness of the way you're talking right now is really important for a lot of people to understand your concerns about the market. And you're far from anybody that's like me that can get a little hysterical at times. I admit it. But the bottom line is all your concerns are very valid. But I just wanted to mention something, and I think it goes in line with what you're saying, Chris. I put out today saying that the overhead resistance on some of the big mega caps, and we're talking Microsoft, Google, even Amazon, and to some extent Apple, is really daunting. And I think that if there's any quarter in the last, well, I can't even imagine, ex-COVID, of stocks that could absolutely get Netflixed, and because they're crowded, nobody's short. I think that this is a real concerning time right now for the mega caps. And truth be told, I shorted Microsoft today. I'm short Apple, and I'm passing on Google just because. So anyway.
Thanks for the kind words. It's nice of you. I've, as Tom said, I've had the pleasure of knowing Tom for a long time. Tom was a client of mine back when he worked at a variety of different hedge funds across the street. I always enjoyed hearing his thoughts and his perspectives. I would say this. I think 75% of your time in this business is spent basically being long, because that's what the data says. So that 25% of your time where you're cautious or uncomfortable or don't quite understand what's going on, you have to go back every day. You have to check your work and say, okay, something changing here that I'm missing. And frankly, I think that's really important for me and for all of us to do, because it's easy to come up with the bear case right now. You just heard me do it. I want to be respectful, and that could change. And at the end of the day, I'm a momentum and a trend guy. And if I got something over the next couple of weeks that looked different, a rally that looked different than the rally we just had over the last 6 weeks, which frankly I thought was just awful internally. I mean, it's possible we get something better here, and I want to make sure I'm intellectually flexible enough and open enough to accept that. Now, not my base case. I think this is a top formation in a difficult tape where you're going to get S&P, down 20, 25, NASDAQ down 30 to 35, semis down 50-ish. Right? That's kind of my framework. But I also know that can be wrong. I find it interesting, George, that in so many meetings, the 94 analog is being brought up. I'm sure you remember 94, right? Basically kept S&P in a range all year. It was a vicious range. You had some severe bear markets at the group level, but you basically kept the index in a range all year. Bond yields went 5 to 8. They peaked on election day, November of 94. This is used often as the feel-good analog because yields peaked in November of 94 and it resurrected the bull market in equities. We know what the next 5 years look like, certainly the next 2 years before the Asians started. But what I think people forget is to get to that point in 94, right? Bond yields peaked in November 8th of 94. To get to that point, it took 325s, 250s, and a 75 from the Fed. It wasn't like the bomb bear market just died one day. It took 325s, 250s, and a 75 from the Fed to get to that point. It also took 11 months. It's April right now. I think it would be early calendar-wise to really position for a big low here.
Chris, let me just pick up on that point, and that's the element of time. the hallmark of one of the hallmarks of the market that we've seen in the last few years is that corrections are short and swift, or sorry, deep and swift, and then you just go back to what is it, BTFD or whatever. I'm not going to spell it out. And so that we've never really had a proper bear market or a proper correction. I mean, even COVID, if you just put your thumb over the chart, you could just say that was a mistake. And the reason I'm harping on the element of time is important because it impacts investor psychology. And Mark, again, it's instructive to consider what's similar to past market cycles, but as you point out, that's also what's even more interesting is what's different. And John Roque, who's in this room, and I hope John will come up, he talks about sentiment. I remember him making this point a few years ago. We're talking about the algos and machines. And it was an interesting point. Like, the reason you wouldn't get huge gaps one way or the other is because machines don't get emotional. They just keep doing what they're doing. They don't panic like humans do. And so this sort of, and Mark Newman is in the wings. He's going to speak next. And Mark, I want you to weigh in on the sandpaper market in Tokyo. And this idea that if you get the passage of time, it just erodes human psychology and sentiment. It just grinds people down. I mean, that's what the bear market in Japan was all about. And people need to give up hope. And so instead of you going to meetings and in Jim Carrey-like fashion, the client across the table is looking at you and saying, "So Chris, you're telling me there's a chance?" No. That's not the way bottoms are made.
Yeah, I agree.
And so could you speak to the psychology of the investor base? Because forget about the bullshit sentiment statistics, all right?
Yeah.
But just from you to real money, okay? Not knuckleheads who are watching Kramer, okay? Real money. Speak just generally to the psychology that you're encountering.
I think muscle memory is a very, very real thing. And that's why I used the examples of the semis before, right? In this QE regime that we've been in for the last, 10 plus years, 13 years, down 25 has always been enough, right? Stocks down 25, buy them all, right? That's the only call you've had to make 4 or 5 times over the last 13 years. You're talking about one of the dominant leadership groups. Talk about seductive narrative around semis, right? What's more seductive than chip shortage and all this stuff? But then you go back and okay, and I think you just raised the point, George. Is it different this time, or was it just different? And are we going back into what is more normal periods of investing, where you get cyclical drawdowns? They're more like 40 or 50%, not 20. There's a lot more cyclicality around the economy. I'm very drawn to like the 1960s. We'll talk about that in a minute. But as I said, like pre-QE, a cyclical group like semis, down 25 was never enough. It was down 50. And I think some of the psychology around semis is a little bit like the psychology around the semis in the early 2000s, where it was, oh, this isn't a cyclical group anymore. This is a secular grower. Right? I hear a lot of that right now. Listen, that might be right? I might be wrong. But nothing on the charts suggests it yet. I mean, talk about 52-week lows. AMAT, TSM, Samsung, NVIDIA, right? The protected stock that can't go down. NVIDIA, what's it? I think 40 off the highs, 40, 45 off the highs. Those are bear markets in the semis. And I don't think the muscle memory or the investor psychology has really adjusted to that. Now, I mentioned the 60s. Everyone is drawn to the 1970s comparison because of the inflation data, but I think it skips the 60s, right? Go back to the 1950s. The 1950s very closely resembled the lack of cyclicality that we saw in the last 10 or 12 years. You never really had much more than, I think, a 20% drawdown in the 50s. Bond yields were effectively 2% for most of the decade. Then you kind of get to the early 60s. You have the 62 crash. That's the only way to describe it, because it was, U.S. Steel and Kennedy and Bay of Pigs and all that. But you basically had 62 crash out of nowhere. And then you rip for 63 and 64, and then in 65 you begin kind of a cyclical topping process. I think the correction in probably peaked somewhere late 65, early 66, but I think it was like a down 25 or so. Then you rallied again, ultimately to the peak in late 68, 69, and kind of putting your secular top. That's a analog that I'm open to here. Like this being your first shot across the bow that maybe the secular trend is beginning to change, and it happens with a 25 or so percent S&P drawdown this time, and it sets you up for maybe the real secular top 2 or 3 years down the road. I'm not opposed to that outcome. I think the bigger lesson of the 60s was you reintroduce cyclicality back into the economy. You reintroduce cyclicality and volatility back into the stock market, right? What were 20% drawdowns in the 50s became 30% drawdowns in the 1960s.
That's great, Chris. All right, let's move on here. We got some really, really smart cookies up here. So we're going to go to Mark Newman, and then John Roque, and then Deer Point. Hey, Mark.
Hey, how you doing, guys? Chris, fantastic stuff.
Thanks, man.
I come to this space to learn things, even though I've been doing this for 25 plus years. And each time I come here, I learn new things. Chris, I just want to highlight, I think you said the economic read that you use was discretion versus staples, right?
Yes, that's correct.
Amazing. I mean, I learned something here. And everyone listening should find little granules like that are just going to make you a better analyst, because the technicals lead the fundamentals, and Chris had this insight on the economy in that reading, and nobody looks at that, or not many people do. So that's fantastic. I just want to make that point here. It's really important. And about the semis, I want to also point something out, which Chris nailed. When Micron is $5, 2007, 8, whatever, 8, let's call it, everyone's saying Micron is tapioca. And then when Micron is 75 or 80 bucks, it's going to $1 million, right? And so that's the mindset in this semi space. And I think Chris nails that right there. And then the other thing, I'm going to just keep giving Chris accolades here, because these are all within sort of my viewpoint of the world. He talked about decade moves, right? And in 2009, tech was 18% of the SPOOs. And now it's 30, okay? And the utilities were 4.3 then. They're like 3.5 now. Materials, 3.4 in 09, down to 2.4. And the big one, energy, we've been talking about, was about 13% in 09, about 2.5% now. And so we're talking about these rotations. And George mentioned the death by sandpaper. Well, this is how it works, right? You get these slow, methodical, longer-term tectonic shifts that we sit here and focus on the noise. So when Chris, again, he highlights these commodity move of the last 5-6 days, that's the Johnny come latelys came in last week, week before, when we on this space were talking about commodities for a quarter or something. And then the last 5 days, major puke, China gets in trouble, and we see tech stocks bid. Dimes to dollars, Chris is right. It's these short-term guys who chase some commodities are now like, oh, I've got to add to the tech space now. Now, onto that tech space again. Chris nails it with the generals being shot. Facebook, Netflix, goodbye. Here's the interesting take I have here. Amazon just broke 3K. I had it as a big number. Microsoft is right on the cusp of that 270 level. Again, big number. I think those two are the next to go. Then Chris talked about Apple, the safest one of all. I'm going to throw one little wrinkle at it. Tesla is the dreamer here. And so when I look at Apple, I have 150. That's my oh shit level. About what, 8%, 7, 6%? When I look at Tesla, it's actually 700 in my eyes. So it actually has further to go. I'm curious which of those two are the ones that fall, which of those two goes down first? And I'm going to wrap it up with just two little points. On the sentiment read, we've talked here about how oversold, but really, is it really sold out? If people go from 125% long down to 75% long, or even 65% long, are they bearish? No. They might tell people they're bearish because they were 125 long and now they're 65 long, but they're still kind of bullish. If you're bearish, you're at 20% long. Hell, you might even be short. I don't know. So that's when those sentiment reads give me a little bit of question to ask. The last thing I want to say, again, Chris nails this. What's missing? What's missing is what Marty Fridson said was missing in last week's space, right? Credit has not cracked yet. And until that does, that could be the final leg in the big bear costume. I don't know. I just wanted to give that all. I got to go do some Uber driving for my kids now, but this is just an awesome space. Chris, that was amazing. And, you know, we see alike on a lot of stuff. And I just think there's some real fantastic nuances you introduced that I thank you for. And George, again, space is just awesome. Awesome.
Wow. So, Chris, I did not pay Mark to say that. So he's a straight shooter. He's a veteran. He's speaking from the heart. So
Yeah.
anything you want to say about that, what Mark was saying?
I wish I could have Mark come home with me and just tell me all those things all the time.
Go ahead. Go ahead.
You know, I wanted to.
How about this one, Chris? Just gun to your head. Is it Apple or Tesla the next to go?
I think Tesla's the last to go. And I think Tesla's the last to go because it really has been the hood ornament of this whole cycle, right? It's embodied every part of this cycle. I suspect Tesla and Bitcoin are probably the last two to go, if they go, right? I mean, that's assuming that we're correct.
Well, just on the if they go, and then I do have to run. I urge everyone to read this Sam Bankman-Fried interview with Matt Levine. It was on Bloomberg. He basically said, yeah, there's some magic to it. I mean, the guy was describing a Ponzi. So I really appreciate that insight, Chris. I think you're right. I do think Tesla is the last man standing, and then Bitcoin too. But fantastic, amazing stuff.
It's funny
really.
that all of these cycles. I was asked recently, I was in a meeting, and a client asked me what I thought was a very interesting question. I'd never been asked it before. A client said at the end of the meeting, he said, Chris, what's the biggest lie that you've been told this cycle? I thought that was a really interesting question because like every cycle, there are these like little lies that have a little bit of a grain of truth about them that get you to believe it. I was thinking about that. It so happened like a week or so earlier, I was meeting a friend from covers software at one of the big shops, and he was telling me about a coverage meeting that they were having where some of the software analysts were lobbying to bring Domino's Pizza into their coverage because apparently Domino's has some great app or something like that. And I had that in the back of my mind. I asked this question, Chris, what's the biggest lie that you've been told this cycle? I guess the biggest lie I've been told this cycle is that Domino's is a software stock or that it deserves a software multiple. The irony is, after all this is said and done, there might be some software stocks that want restaurant multiples at the end of all this, but we'll see if it gets to that.
That's awesome, Chris. So I'd now like to go to John Roque. Hey, John, I guess one of the places to start, John, if you could just weigh in, there's a slight correction I think that needs. Can you please speak to what you see as the true technology weighting in the index right now? It's far more than 30%, as I recall you saying.
Okay, I'm walking down Madison Avenue, so if it's loud, I apologize. Chris, good to hear your voice. George, thanks for having me on. And Chris had some great comments, but I want to say first and foremost, Chris is one of the good guys in the business, if not one of the better guys in the business. Just a very solid guy, and it's my pleasure to know him. So somebody said that tech is 30% of the S&P. I've adjusted it. It was 45% in December, and as of Friday's close, it's 40% of the S&P, according to the way I did it. Now, of course, I could be making a mistake, but it's 40% of the S&P by my weighting. So it's way above anything the S&P will tell us it is, and I think their last weighting was 26% or so. So it's way above, and there's no way that tech is anywhere near what it was in the year 2000. It's way above that in terms of weighting, market cap, etc. So my number's about 40%. And George, can I ask Chris a question?
Go for it, John.
Okay, Chris, thanks for your comments. Always cogent and to the point. So I've been doing this a long time now, but I'm always trying to upgrade my indicator game, either because I should eliminate something, or maybe I should consider adding it. For me, and for others who are listening, of course, can you tell us how you either add stuff to your indicator base, remove it, and which have you found to be most helpful over time? And and if it's trend or if it's whatever, can you just help me with that? Thanks a lot in advance, and always a pleasure to hear your voice.
Yeah, John, great to hear you as well. John, I've had the pleasure of knowing John for going on 15 or so years. John's been a mentor of mine, so um, great to hear from John. I thought before I answer that, I want to add one point to something John said about tech's weight. And I was thinking about this. Let's say it another way, right? John calculates that tech is still upwards of 40% of the S&P, and I would just simply pose the question: does a bull market in tech revive itself at 40% of the S&P? I made the 94 analog earlier, and frankly, I'm a little bit skeptical of the 94 analog. I think it's important to remember that 94 was right before the beginning of a massive speculative ramp, to steal a phrase, in tech. And I think one would argue that we may have just ended a massively speculative period when you look at the ARCs and the IPOs, and as I call them, the baby fangs or the aspirational fangs. I thought John asked a very good question about indicators, what I care about, what I look at, and either adding stuff or removing stuff. I found the simpler I behave and the fewer the things I look at, the more cogent and hopefully the more helpful my call is. And I tend to see things clearer, I think, or I tend to see the ball better when I'm removing stuff from my process, not adding stuff from my process. And at the end of the day, what is the most important input for me? Just show me the 52-week high list and show me the 52-week low list. I think that is such a good starting point in terms of understanding what type of market regime you're in. From there, we can go off in a lot of different, but if I need, first thing I need to do, I need to understand the market that I'm working with. And I think there's no better reflection of that than the 52-week high list or the 52-week low list. My personal favorite quote indicator is simply how my shorts are doing in my PA. When my shorts are making money in the PA, and I know I can't publish stuff like that, but when my shorts are making money in the PA, it typically means that the trend of the market has changed or is changing, or perhaps the trend of the market doesn't jibe with what the consensus wants it to be. And when I spoke earlier about seductive narratives, we're always sold these seductive narratives. Ask yourself the question every day: does the market justify whatever seductive narrative out there that we're being sold? I have found personally, when I try to be too elegant or eloquent, perhaps, with my views, I'm about to be wrong. I prefer, what do I do every single Sunday? Look at every single stock, basically, in the world. I think the clues come from that exercise far more than they come from some macro indicator or some oscillator or whatever it may be. But great question, John. Always great to hear from you.
Yeah, so Chris, this is both for Chris and John, the two of you, because you're both veterans. So on that last point, looking at so many different charts on a Sunday, maybe all the charts of liquid names you can possibly see. So I want to go back to the concept of the 10,000 hours. I think it was Malcolm Gladwell, the Beatles 10,000 hours, Michael Jordan 10,000 hours. Like, you got to put in the work, and so the muscle memory from the pattern recognition of just forcing yourself to just look at all those charts, and it becomes like it's muscle memory. And by contrast, the sort of fake it till you make it, narrative driven, liquidity driven, thematic bullshit that someone comes up with on CNBC is not subject to any rigor. It's all vaporware. It's a goddamn story. And it just, in this, there was a great book written a few years ago by Alan Keyes called The Post-Truth Society. It just seems to me we see that played out every day in the stock market. And so I was brought up, and I suspect, John, you were, and Chris, you were, you do the work, you put in hard knocks. It's only by putting those 10,000 hours you become proficient, and you can't fake it. And I think, to the way, from where I sit, this market the last few years has been a giant fugazi where it's just liquidity has sort of overcome everything else. So I don't know what the question is there exactly, but so maybe, John, So Chris, you want to go for it, or John? I know you have thoughts about that. So,
Well,
it,
I'll just say I'll just say very briefly, and then I'll let John kind of do the hard work. I'll say very briefly. When there's 90% of stocks above the 200-day moving average, no one on this call needs my help or George's help or John's help. You can't be wrong when 9 out of 10 are working. Maybe we can help at the margin with leadership and the like. But when we're dealing with an environment like we've largely dealt with now for 6+ months, where you're talking about between like 40 and 60% of whatever index above the 200, I mean, things get hard, and you got to do your work, and you got to be open to new ideas. I do that exercise of kind of looking at every name because you pick up changes in the groups there first. All these boutique investment banks are breaking down. Why is Evercore, Moelis, and Lazard and Piper all weakening, right? Or something I've been on lately is all these publicly traded private equity names. I think that's the next leg down here, right? Apollo weakening, KKR weakening, Carlyle weakening, and you see that by looking at the stocks every single day, understanding how they trade. I think John has a similar experience, but there's no substitute for actually looking at the names as often as possible.
I would echo Chris's refrain, and George's comment about the pattern recognition. Sometimes you end up looking at something and you'll say, my goodness, that looks like something else. For example, if you look at industrial metals prices, you would say that it looks just like the World Food Price Index. And of course, that makes total sense because when there's an inflationary regime, industrial metals are going up and so are food prices. But the only way I think that happens, and Chris gave a great answer to my questions and great answers to my questions, and he just said it. When you see all the charts, the message is there. And I'm going to use a Stan Weinstein line, and George had him on a few weeks ago on a Saturday. Stan's line from the professional tape reader was the tape tells all. And I think Chris Verrone is a disciple of that. He just told you so. He goes through a million charts on a Sunday, and he gets his kind of marching orders from the market. He doesn't go to the market with the marching orders.
George.
Chris, thanks. George, thanks.
Thanks, John. And John, I would add to that, and George, I think this speaks to something you said earlier. There seems to be a tendency among a lot of people right now to think every tick matters. Like the big question I was getting today was, I think ARK was up 3% or something today. Chris, what does it mean that ARK was up 3 today? I don't know what it means. It's in a bear market. Things in bear markets rally from time to time. If it's changing trend, it's way too early to know. Let's revisit it down the road. There's a tendency to want to believe that every tick higher is the start of the next rally that one can't miss. And I mean, that was really evident the last 6 weeks, right? When there were a couple days where like small caps inexplicably outperformed. And, Chris, what does this mean? What does it mean that small caps are outperforming today? Maybe it means nothing. And, what made a 52-week low today? Russell 2000, right? So I think this obsession with every tick as conveying a message distracts from what I think many of us do best with his good, solid trend following work.
100%. And again, for Chris and for John, I got the both of you up there. And we're going to go to 3 aces and Deer Point in a second, but I just want to ask you guys one more question. So, again, you talk about keeping it simple. I just jotted this down. If you just trade what you see, not what you think. 2, just follow the trend and do more of what's working and less of what's not working. And 3, don't fight the Fed. The Fed wants stocks to go down. Like, how hard is that? However, that's going to lead you to a place with inconvenient truth for pretty much all institutional investors because they're all fully invested for the most part. So, John, Chris, any of you want to take that? Because to me, it's pretty simple based on what you were saying, Chris, and I agree. Go back to basic first principles.
George, I think for as easy as it is, I can go through, my own trading over the last year, a couple years, and man, why would I own this? This violates everything I believe. Why would I own this? So practice and execution, like in any endeavor, right? you can practice it great during warm-ups, but can you execute in game time? It requires such a discipline to be able to do the latter, and I think we're all constantly trying to execute better and stay as disciplined as we can. But the reality is, this is a hard business, and it's hard to do. I can't tell you how many times in the last week or so I've been asked, Chris, is it too late to sell this? Or not even last week, frankly, in the last 6, 7, 8, 9 weeks, Chris, is it too late to sell this? Is it too late to sell that? I think it's never too late to sell something.
Well, Chris, I'm just chuckling listening to you say that. Is it too late to sell it? I mean, they're telling you what they want to do. They just want to blow it out, and then they're asking you to sort of bless their trade. It's like when and I get this too. And by the way, for everyone in the room, I make all the mistakes that Chris is talking about. But George Soros, I think, used to say it's like when his back started to bother him, that was his indication he's got to get out. Okay, the fact that you're even I know when I'm even asking myself that question,
it's time. Yeah,
it's time. But it's the participant bias. It's like you think you could fool yourself. It's like you're asking for permission to sin. You're asking for somebody else to tell you to do it. But the fact that I'm even asking you that question, that tells you all you need to know.
Yeah, I mean, there's such a fear of, what if I miss the next rally? Right? What if I miss the next rally? We talked a little bit about that in our work today, and we talked about this idea of, listen, when the trend is down, and I would argue the trend is down for a lot of the major indices. When the trend is down, you need some trigger or some system to get you out of the mean reverting bounces or the oversold bounces, the bear market rallies, if you will. And like something as simple as, okay, I think we're in a bear market, but I recognize there might be very tradable rallies along the way. When that tradable rally, if it goes on, it makes a new 3-week low or a 4-week low or a 6-week low, some number, right? Choose some number and stick to it. You're going to preserve capital if things get nasty again. All the greats have always talked about, this is about slugging percentage, not batting average, right? Any trend following system, at best has a 50-50 hit ratio, like at best. That's a good one. But the slugging percentage is what's important, and avoiding or preserving capital, or at least preserving 70% of your capital in those bear markets, right? Because every bear market starts the same way, at a high, right? And preserving some capital in those events is so essential to long-term return.
100%, Chris. So before we go to three aces, I just want to remind everyone we're here with Chris Verrone, head of macro technical research for Strategas, doing an unbelievable job of sort of focusing our attention on what's a tricky proposition. It's not an easy business, but basic first principles and a lot of wisdom. We're learning a lot from you, Chris. I really want to thank you. As everyone knows in these rooms, we're doing this for no financial gain. Chris is here because he wants to teach us, and hopefully he's enjoying himself. But I'll just remind everyone, for us to have access to people like Chris, it's really extraordinary. It's very unusual. Got to cost tens of thousands, about hundreds of thousands of dollars to have the access to the kinds of people we have in this room. And so I ask everyone, if they haven't done so already, to please consider making a contribution to World Central Kitchen. To my Twitter feed, I'll put it up again. They're doing God's work. They're providing hot meals for, in this particular instance, at this date and time, people in the Ukraine. They actually have gotten bombed on. There are other organizations which won't go into the Ukraine because you're literally taking your life into your own hands. So World Central Kitchen is really doing God's work. And we're in this room. This is your first world problems. Here it is, we're trying to preserve our net worth, increase our net worth. There are people out there who really, really need our help. So, we do these rooms for free, for no personal gain. I want to leave. I think we all, in my religion, you're taught that you should try to leave the world a better place than you found it. And so I ask everyone to pay forward and please donate generously to World Central Kitchen. I will say we do have a benefactor in the room. This person has pledged $2,000, provided we get a match. This person's going to match $2,000. So if the room can contribute $2,000, that will be doubled. We will have $4,000, and we're just about to cross 60. So again, I'll put the link up to the top of my Twitter feed. please give generously to World Central Kitchen. All right, with that, we're going to go to Three Aces, and then after Three Aces, we're going to go to Deer Point. Three Aces, my friend, how are you?
Hey guys, George, thank you. Awesome as always. Chris, nice to meet you.
You too.
Chris, thank you. I have a sort of a thesis here with a question. So to me, what we've seen thus far, I think there's three parts to the trade. Part number one is a 2000 tech wipeout, ISK thing, which I think is what we have seen and are seeing, right? Part two is the QT, which we've seen a grand total of 25 basis points of, and all of this has happened. And then part three is the potential trade for the recession, right? So in 2000, we didn't get a recession with the tech meltdown. So my question is this: if the real estate market is doing what we're catching anecdotes of now, which is stalling and basically stopping on some level, which is some of what we've heard, and the Fed thinks that it would put us clearly into a recession territory. Do you think there's risk to the short side if some of those vibes start coming out of the real estate sector that it would be putting us into a recession by them doing the raising of rates and the quantitative tightening? I'm just always looking for risk and potential change, and we have stocks that are down 60-70%. And by all accounts, most of them are worthless. I agree. But just trying to see if there's a measure there of risk that we should be paying attention to. Thank you very much for your time.
Really good question. I would just say this, and I think this is going to be an unsatisfying answer, but the recession calls are relevant to me. The market's going to decide on recession or no recession long before you or I figure it out. I think what I said earlier is important. I think many of us in the room would agree. The market's a better economist, certainly than me, and I would assume than many of us. It's better strategist than us. It's going to vote on recession or no recession before we have the ability to figure it out. Now, what I've said recently in our work is that I do think this market is kind of priced in half of a recession, meaning when you look at the leadership, right? Pharma, staples, Utes, etc. There's a case to be made that is very recessionary leadership. I actually disagree. It's pre-recessionary leadership, right? Because those groups, pharma, staples, Utes, REITs, are both going up and outperforming, or outperforming and still going up. In recessionary leadership, they're only outperforming because they're going down less, because nothing goes up in a recession. So I want to make a distinction there. I think it's very tempting to say the leadership looks recessionary. No, it doesn't. Even the safe havens break in recessions. Think about Walmart in summer of 08 or Exxon in summer of 08, right? Those are the last things to ultimately crack. That's not this market yet. It may become this market. I have no idea. I think it's still in a forecast, but that's not this market yet. So drawing that distinction between pre-recessionary leadership and recessionary leadership, I think, is a very important thing to do.
All right. So thanks, Chris. Chris has time for one more question, and he's got to move on. So, of course, the room is going to stay open. But Deer Point, the last question for Chris is yours. Go ahead, Deer Point.
Yeah, thank you, George. And so I guess it was kind of similar to Three Aces' question. If I was looking at S&P breadth, Nasdaq breadth, the Bloomberg percentage of New York stocks closing below their 200-day, the breadth is deteriorating. I think it was about where it was on the rebound after the drawdown in the beginning of COVID, so probably around the summertime. But where I'm wondering is if markets are going to end up rallying is if the Fed ends up backing off. And the only reason I'm wondering about this is I've picked up some research that was left behind from an economist back in 2015, and I haven't seen him update anything anywhere. But I've been looking at cross-currency basis swaps, and without getting into the technicalities of that, it seems like there's a massive shortage, especially if you look in the euro, like the EU, on this basis swap. Where basis swaps are heading, they're back to where we were during the beginning of let's say the pandemic. So yeah. I'm wondering, I know the Fed thinks their mandates the United States. You have this whole euro dollar system. It looks like, broadly speaking, there's a massive shortage of dollars. The Fed's saying that they're going to tighten and draw in liquidity, but the rest of the world seems to be needing US dollars. And do you think that this kind of leads to maybe where the Fed does end up backing off, and then obviously, I mean, the market would just, I would say, continue its trend upwards.
So this is tricky. We're introducing more variables, right? We're saying we're creating all these if-then statements, right? If Fed does this, then market does that, or if Fed does not do this, then market may do that. I think that's a really tricky game to play. Now, the irony is, of course, we all play it. We'll sit here and we'll talk critically of the Fed, but then 95% of us come the May 4th Fed meeting, we're all going to huddle around the screens. We're going to parse the statement and see where the new dots are, right? I mean, that's a joke we're playing on ourselves. So I try not to do those things. It's unavoidable from time to time, but I try not to do those things. I don't think I can credibly say the Fed has no credibility and then read the statement as if it's and then claim it has any credibility. I would add to the following. It's hard to find examples of the Fed being this late. I think maybe we can agree that the Fed's late here. The Fed being this late and the outcome being ideal. I'm sure there's some level. I'm sure there's some S&P level or some 10-year yield level or some dollar level that gets the Fed to back off. I'm not sure it's S&P down 13%. Maybe it's down 25 or maybe some other number. I'm not convinced that it's here. But I want to be really careful that we just don't get into this game of game theorying the Fed. That is not our objective. Our objective is to buy good charts and sell bad ones. I'm of the view that there's more bad ones than good ones right now, and that will, at the minimum, take repair.
Chris, that's really phenomenal. It's funny. We joke about how everyone's an armchair economist is expert in the yield curve. Before that, they were experts in foreign relations and the Ukraine-Russia situation. Before that, they were all experts,
epidemiologists.
Epidemiologists. I mean, it's like, and this goes with narrative.
Yeah.
And so, no, hey, man, listen, you've been really generous with your time. This has been an absolutely fantastic room. I hope you will consider coming back, Chris. This is great, and I know the room. This has really been awesome. So, Chris, thank you so much, and
thank you, George.
Back and visit us.
I would be privileged to come back, and thank you everyone for the great questions. You're doing a great thing with these spaces, and look forward to participating in the future.
Thanks, Chris. So we're going to move forward. Hey, Matt Cox, if you can hear me, I saw you had is the World Central Kitchen thing up in the nest right now or not? It was there.
Yeah, George, I just put it up there. It's there.
Okay, so thank you, Three Aces. So again, we have a pledge, a matching pledge of $2,000. If the room can raise $2,000, that'll be $4,000 total. So the link for giving is up above. We're about to cross $60,000. And just to remind those of you, I'm hopeful that on Thursday we're going to raise a lot of money because our next broadcast or room, if you will, in lieu of a room on Thursday at 3:30 Eastern, there'll be a live stream of the keynote address of the CMT conference, which John Roca and myself will be giving the address. And so I'm hoping that forum, which will be viewed by thousands, tens of thousands, that's going to give us a real boost. So again, we're all doing this, pitching in, trying to help each other. And this is just an incredible room we've created. I say this with all sincerity. I think we have the best rooms on Twitter, period. We have the best speakers. We have the best content. We have the best moderation. And we have the smartest audience. And I defy anyone to show me a better forum. And the proof of that is look at each of you, and you all keep coming back here, and you come here for a good reason. I mean, I'm just looking here at just the first few rows from, Three Aces, Mark Newman, Tommy Thornton, Tony Greer, Michael Kantrowitz, Chris just left, KFAB. I mean, this is sick. This is really sick. You can't find this anywhere. So again, please give generously. People need our help. All right, so let's move on here. If you got a question, raise your hand. I know, Tony, you're having problems with your with the Twitter app. I see my friend KFAB. I see Guy Serendulo, Gilberto, Cardi, Jackson. Come on up, as they say. I really appreciated the way Chris was very more careful speaking about markets than yours truly typically is. One thing that we talked about sentiment earlier, and one of my pet peeves has been the way people are using the sentiment data. And they just, I was going to go on a Twitter rant today, of course, redacting the names, but calling out some of the people for the blatant misuse of sentiment data. And I don't know if Tom Thornton can come back up here, but one thing about sentiment, bear markets are not the same as bull markets. And yeah, on a big downdraft, you can and you will see sentiment get really depressed. But in a bear market, do not expect sentiment to cycle all the way back up to the highs. Sentiment, if it can just get halfway back up, it's kind of like an RSI. Oftentimes, that's all it will do. And so there's been a lot of misuse about sentiment. All the apologists, those who have PhDs in what I call stockbroker economics, which is sort of like the soundbite du jour. It's catchy, but it's empty. The one making the rounds has been, and here he comes. I got Thornton up. He's a master of sentiment. And Tommy, I'm going to hand over to you. You got to bail me out on this. And so it's like they say, don't try this at home. If you're going to want to look at sentiment, you turn to a pro like Mr. Thornton or Chris Verrone or John Roque or Tony Greer. But there's just so much blatant misuse of sentiment data. So Tommy, bail me out on this. I kind of put my foot in my mouth. I'm looking to you to take over on the sentiment question. Tommy, the floor is yours.
Okay. Well, there's a lot of ways of looking at market sentiment, and I was fortunate enough to be a client of Ned Davis Research, and they had one of the best sentiment polls, the crowd sentiment poll, but they had variations of it, and it'd come out every single day, and they had about 8 different inputs, and they used Market Vein, Investors Intelligence, the Daily Sentiment Index, some other proprietary things. And I went out one evening with one of the analysts, and I said, "You got to tell me what's in." He goes, "No, I can't. It's a sworn secret." But I got him drunk, and he told me basically how it all worked, and it goes back to 1973, and there's been updates and changes to it. And that's another thing, that market sentiment, there's various sentiment polls that change over years with different methodologies that adjust, sometimes for markets, sometimes for new people that come in. I know the Investors Intelligence crew, there was a turnover a couple of years back, out with the old, in with the new. But I tend to focus on, I use the Daily Sentiment Index, and I find that to be quite good. It's run by a guy named Jake Bernstein in San Francisco. It's a lot smoother than it used to be way back, and I have historical data going back to 1987 when he would ask just any trader, dumb traders mostly, what are you, bullish or bearish? So it was a very easy input question. So you could calculate, well, 90% are bullish, and that's overbought. You go to 10%, and it's oversold. Now, the thing about sentiment, and it's really important, is sentiment is a condition, and it can stay oversold or overbought for quite a period of time. So you have to look for triggers, and we use different technical triggers. I use the mark indicators. I sometimes use a moving average of really, it's worked very, very well, especially in the last couple of years. In March of 2020, on the 23rd, I think we had the S&P bullish sentiment at something like 3% bulls or 4% bulls, and that is just absolutely devastatingly low. And that combined with the mark indicators as a trigger, it really worked out as a good buy signal. And right now, I think what Chris Verrone, and Chris and I have talked about it, that we are more in a position of a bear market. I know that we've had other people, John Roque has talked about this, but basically we're going to see these sharp snaps, and we're going to go back up. And again, let me just get the latest data. Today's data on the S&P is 23% bulls, and it was on Friday, it went down to 18%. So we had a bounce today. That's good. In the March lows, we hit 10% bulls. And I do think that we're going to break the March lows again. And part of the reason is, and I'm kind of deviating a little from sentiment, but we have on the major indices, DeMarc sequential countdowns continuing to move lower, and they're only on day 3 or 4 of 13. Now, they don't have to go in exact order, but when these start to kick in, I get a little bit more cautious of what's going to happen. So we'll get bounces in between. And certainly today we had DeMarc in my first note. I pointed out the S&P futures had DeMarc countdown 13 buys on the 60-minute time frame. So you got to measure different time frames, which worked pretty well. But the AAII pull, I don't use this pull, and I'll tell you why. And a lot of people, on my entire time on Wall Street, I would always get hit by sell-side brokers and analysts saying, oh, the AAII pull is at this low level and it's a buy. And they just didn't get it. And the problem I have with the AAII is they're not asking, are you bullish or bearish? But you're getting another answer that you can answer and say, oh, I'm neutral. So first of all, if you ever worked at a hedge fund and you go up to your boss and you say, hey, look, I'm neutral on this. You know what he's going to say? Well, what are you bullish or bearish on? It's a cop-out excuse. So it skews that data, in my opinion, to where it is almost worthless. And so I don't use it. And yeah, I'll look at it when it gets to these extreme levels, and I look at other things. I actually really like the CNN fear and greed, because it's not necessarily what traders are telling you they're doing. It's what they're doing with put call ratios and other, there's 7 inputs on that. So I like that one a lot. And actually at the March 2020 lows, I did a snapshot on it. It was at 1% bulls. So I don't know. That might have been me as the 1%, because I really started to turn bullish at that place. But sentiment is a condition. Beware of some of the when you see it at certain levels, you want to use another indicator to gauge the turning point. And I like it at extremes rather than trying to fight it out in the middle range. I mean, that's what, George, remember I was on, I think at the recent highs, and I said we're kind of in no man's land, and I didn't have a great read either way. I took
Yep.
some longs off, and I just was like, I can't short, I can't buy anymore. And a lot of times, a lot of indicators, a lot of technical indicators, like an RSI is another good one, which when they break 50%, the 50 level, that's almost to the downside. That's like almost a confirmation that you're going lower. And a lot of times they'll bounce up to the 50 and then fail. And the same thing happens a lot with market sentiment. So we had a bounce, it's come back down. I think we're just going to be chopping it down at these levels. And if we get to 5% bulls, you'll see me on Twitter saying, okay, this is a good time. And when everybody's looking at the sky and there's mushroom clouds, people think it's nuclear bombs. I'm looking at it like factories are reopening. That's just how I'm wired. So that's kind of it.
So, Tommy, let me ask you one question, because I saw in your note today or Friday, you actually made a good scalp trade. You shorted some of the energy names. What are you thinking about energy right now, Tommy?
Well, it's a bit of an unwind, because you've got a lot of people that navigated towards the green of energy, and energy's been run up so nicely, and it's been a great trade. But I think it just got too overcrowded, and there weren't a lot of people short. There was a lot of covering that we noticed going up. Jeff Garbaz was mentioning it with me a while back. And I think people also didn't realize what was going on in China. And I still don't think people realize what's going on in China with lockdowns and how much oil is actually coming off the market. And I'm not an oil expert, and there's a lot of oil people in here. So that's just my, overview of, the low level analysis of it. But I look at sentiment, and that I think was important. Oh, one other thing about yield curve and all the people that, the narrative changes. The Drudge Report is a great sentiment read. When they posted something at the inversion, the absolute right before it turned, yield something about yield curve on the Drudge Report. And I used to tell people, like I'll tell people when they're not market professionals.
Wait, Tommy, wait. The Drudge
Yeah,
Report?
I think I screenshotted it.
Oh my
But
God!
whenever, like I used to tell people, I mean, first of all, I always tell people, you have market sentiment always in front of you on how people are acting. That if people are out there buying, expensive cars or whatever, and they're acting a little too rich for themselves. That's a good read, and we've seen a lot of that in the last couple of years.
I was actually in the room when you and Three Aces called the top in oil 130 when I was up there. So yeah, based on sentiment analysis, I'll never forget that.
Yeah, no,
Hey, Tommy, did you get the 200 death threats that I got? Sorry, George.
go for it.
Tommy, did you get the same business that I got after that? I got dogpiled by about 50 guys for 2 weeks.
Like what? Like you were,
when we were both talking about oil that day at 1:30, and we said hit the bid. I'm just joking around. Forget it. It's a joke.
I didn't get a lot of people with a lot of pushback, and I can always tell when I get and I'll put stuff on Twitter, and you get pushback, and one of my favorite things is when I say I'm shorting oil or buying oil, whatever, you get the good luck, and that's like the sarcastic one. I also have gotten the ones where they remind me in 1 week type tweets, and those are always fun because they never remind me. But the other thing I'll leave you with this, that I always used to tell people, when it becomes the nightly, first story on the nightly news, or it's on the cover of your newspaper, and you see this trader with his hands, in his face, and he's all upset. That's probably a good level where the market is about ready to go. And actually, the meme stock thing was crazy with GameStop. When it was picked up on every news channel, local news, nightly news, the national news, and my daughter, who's a film student, called me and said, "Hey, Dad, what's going on with GameStop?" That was the top right there. So it's all around you. You can read it, you can see it, smell it, feel it, and that's the most important thing about market sentiment. It's all around
Tommy,
us. Yeah.
Yes, Tommy, as long as you're up there, I want to get a free shot here. So going to some of the big FANG names are going to be reporting, or near FANG names that are going to be reporting in coming days. I mean, I look at Apple and NVIDIA, all this stuff. I mean, Apple to me looks like a train wreck about to happen. Or put it another way, I have no idea. Let me retract that comment. I have no idea whether Apple numbers are going to be good or bad. But here's what I do know. You could get Netflix. You could do a Netflix. You could do a Facebook. I mean, God forbid, if the numbers are mediocre or the guidance is poor, you could have 20% off sale just like that. And conversely, if the numbers are good, I don't think the stock's going to go up very much. So to me, and again, this is do your own work. I have no special insight, but just me from a game theory perspective, I mean, heads, decent numbers, decent guides, it might go up a little bit. Tails, if they make one false move on the numbers or the guidance, you're going to take the elevator down. So do you have any view on Apple or any other large cap tech names that are reporting the next few days?
Well, one thing about the one thing that we have been watching really closely, and it's worked well, is we've been noticing a high amount of put buying right now with Apple. And as much as like people will think, then that's good, that's because that's what the Nigerians have taught everybody on CNBC. That's the smart money. It's actually not. It's when you see this heavy put buying or heavy call buying, it's actually happening at the absolute wrong time, and you can fade that. So I'm short There's a DeMarc signal sequential on the downside right now. I feel like this is the most crowded stock in the world, and if they if they come out and their guidance isn't very good, I think the stock could get hit. It could get hit, and we're in that kind of market where people aren't going to waste time selling. They're not going to sit around. That's they're just going to take them behind the barn and shoot them. And look, I think the Morgan Stanley analyst Becker, I forget. Anyway, she was a little cautious on Apple. She loves it long term, but she's cautious with potential guidance. And if China is locking people up in their cages again, I'm telling you, that's going to hit Apple in two ways. With factory production, you could have supply chain problems again, and phone sales and other things aren't going to be selling in China right now. And I think there was a lot of demand pulled forward in the last 2 years. So that's a concern. I mean, look, it's hard to short Apple, but because you have a buyback that the guy basically puts his elbow on the buy button all day, and it's hard to fight that. But let's see what happens on this. I think it's a little bit. Again, Google has gone straight down. They have a DeMarc signal on the downside. I wouldn't want to short that right now. I think that is a little precarious, and they can basically print any number they want. Microsoft also has a DeMarc signal. I shorted it, and they've beat numbers almost every single quarter for the last 20 quarters. So I think they're kind of due to, slip up a little bit here. And again, this is the quarter. If they do it, I think it's going to get. You're going to see people sell and ask questions later.
That's great, Tom. Appreciate it. All right.
Hey, George, real quick. It's Newman here. I just want to add one thing to what Tommy said there about the post earnings is super important, because if you look at the airlines, Delta had really good numbers. Those guys were sold from the open on the day they blew out earnings. And then look at what happened to FCX and Cleveland Cliffs. Cliffs had a great number. Lorenzo Gonzalez, one of the best CEOs in the biz. Stock gaps up on the open. I think it's down about 10 or 12% from the earnings, which were fantastic. So I think we're in that stage, like Tommy just said, people selling first and asking questions second on any sort of question at all in the report. So these earnings for Google this week, et cetera, Apple, super duper important, really important.
Great
And
insight.
George, real quick, also on that, just very quickly.
Yep.
Amazon's 500 of their 700,000 user slip was Russia. I'm just curious, does anybody know what Russia sales are for Apple? And did they cut Russia off like everybody else? Just wanted to put that in there.
Three Aces, can you just repeat the question, the numbers again? I didn't quite get it.
Yeah, so if you look at Amazon, they slipped 700,000 users, but they said 500,000 of them were Russia because they cut Russia off because of all this. I'm just wondering, Apple, in this sort of, state of confusion with Foxconn and zero COVID and sales in China and manufacturing and so on, does Russia have a big, does Apple have a big Russia presence that they've also shut off that could be on the headline there?
I have no idea, but it's a very good point, Three Aces. I guess what I would say, if you're a CEO of a company, if you're just say Apple and you got all this China uncertainty and everything else, you've got a perfectly good free hall pass to just say, given uncertainty, we don't really know, blah, 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 blah. I mean, I don't know. If I was Apple, that's what I would do, but who am I to say? So I don't know if anyone has an answer to the Russia question. All right, so if somebody does this, good question, Three Aces. Let's just if somebody else on stage can answer it, that's great. Otherwise, we'll just keep going here. All right, so I want to establish an order here. We're going to do Randolph Duke first, followed by Simone, followed by KFAB. Randolph Duke, good to see you. What's up, man?
All right, so I got one freestyle riff for 90 seconds or less, and then I got a question, but I'm going to lead it off with the fellow before me was asking about Netflix, not Amazon. So here's the freestyle riff. So I'm a value investor, whatever. I've taught at Columbia Business School and worked under Bill Miller, blah, blah, blah. And a lot of value investors that think they know how things work and they have this biblical view of how things should work, they will say technical analysis is voodoo, which I think is a bullshit viewpoint. I believe that technical analysis is a visual depiction of changes in fundamental expectations embedded in the stock price, which means that TA is entirely fundamental. So, end of sermon on that one. My question to you is I've been buying QQQ Complex starting with the blow up of Netflix in late January. And I've been slowly waving it in, and like I like my exposure, and there's a lot of value here, and I just feel the pod shops just selling this shit every day to go after energy and stuff where they don't know what they're doing, and they're just going to get housed. So my question is, what do you see in QQQ? How can you aid or add to the sort of trading pattern or plan of a fundamentally based investor who's got maybe net 15 points on there and is looking to add another 15 and just to round out the exposure? Thanks, dude.
I'm also short Qs. My
You're,
maximum.
you're not also short. I'm long.
Oh, you're long Qs.
Yeah.
Oh,
Yeah.
oh, okay.
I know y'all think of me as this bearish guy, but
No,
I'm
it's
long.
okay. And you bought them
Starting with the blow up of Netflix in late January.
Okay.
Stop now.
Well,
Or Tommy, while you're looking for something, Mark.
I got to think about this.
Yeah, Tommy, just hold that thought for a second. Newman, I know you have an opinion about this. You want to weigh in on that?
You gotta stop adding to the losers. Losers add to losers. The thing is about George and I talked about this slow drip torture, and the stocks that go down the least in these environments are the ones that are least owned. The ones that are most owned, the most people have the reason to sell them because they're all long. And so in the tech space, we talked about this earlier with Verrone, the weighting in the tech has gone from like 15 or 12% in '09 to, I said 30. I had some stale data. John Roque said it was closer to 40. Let's say 35. We'll keep it happy. That means 35% of the dollars in the market are in tech, basically. So let's do this. Let's add, when your position goes in the green, then you add to it. Don't add anymore till it goes green.
Yeah, I mean, look,
That's it.
we could do hours in terms of how you average and whatnot, but let's just please assume that I'm a 53-year-old guy that's been around and I've got a plan, and the rote application and strict unbending application of any trading rule is never the right thing. So some people never average, some people always average. The key is to average intelligently. So I appreciate the input, but I got a different point of view on that.
Okay, I mean, look, listen.
Mark, hold
everyone
on.
has their own views
Mark.
on how the things work. It's
Yeah,
fine. We can do that.
Mark, hold on. Let me try to be Switzerland here. So Randolph, could you explain just, I mean, what your viewpoint, like what's your thought process behind wanting to get long QQQ?
Well, I am long QQQ names, so we're talking things like Netflix, Airbnb. I've got put on some PayPal. I want to say like 40 trading sessions ago. Put on Google, and I added to an existing Facebook position that I had halved last summer with the ATT thing.
Right, but is your thought just that the stocks are like cheap now, or
They're cheap. They're cheap.
They're cheap. Okay.
Yep.
Got it. So yours is a fundamental assessment. It's not so much looking at the charts necessarily.
No, I'm not a trader. I mean, I'm an investor, and my explicit forecast horizon is always 5 to 15 years. And I believe you know who I work for. I mean, someone that averaged heartily in things. And so I have a plan for averaging every time I enter a position. I have a risk budget laid out, and I have a fundamental viewpoint. And this thing is basically followed my fundamental viewpoint that I can add slowly, and I can get to my desired exposure over a certain time period. And so I'm just basically wondering, from those that employ the black arts of TA, when do you think it's done, or what's like the next 30 days?
Okay, I got a couple of thoughts. Well, here's your risk is the Q's breaking 320. Those are it hit that in 224. It hit at 3.8, and again on 3.14, it bounced off of that. If you break below that, you have the risk lower of at least 10%. That's my assessment.
Yep.
And if you're cool with that, then I'm fine. Look, I get you're thinking long term. It just may be a lot longer term than you expect. Because here's the other thing. I don't necessarily see any radical snapback happening, as Chris Verrone pointed out. There's not a lot of upside momentum happening, and the other thing
There's
is
a complete dearth of it.
right. Well,
there's none.
Right. but that's you have to remember that nothing motivates sellers more than lower prices, and
Oh, absolutely.
and I mean, look, first of all, I don't endorse being long queues.
Yep, I get it.
And I'm nothing. You're a fundamental person, and you have your reasons for it, and I'm not going to talk you out of it. But I'm just saying, if we break these levels here, we could have a protracted period of underperformance, and we've seen that quite a lot.
Yeah, I get it. I get it. Yeah, I get it. I mean, I have my crop years basically where I'm setting it up and I'm expecting the flowers of the crop to come up 2 years to 3 years, kind of thing on average. And so, I always sort of buy into these negative momentum streaks. And you got to have an idea on how to average non-emotionally, because I think the soul of risk management is ego management, and a lot of the dumbest billion-dollar, like $10 billion losing that takes place with averaging is always emotional, ego-driven. I'm going to average down because I'm right. And that's how you blow up a firm and your reputation and everything else.
Well, okay. I understand, but what's your time horizon? I mean, let's start there. Let's just play, trade doctor.
Yeah. So look, I don't have a time horizon. My explicit forecast period is 5 to 15 years. My average time in market over the course of a 25-year career is about 2 to 3 years. So if it gets to what I think is, fair value tomorrow, boom. If it takes 4 years and, my IRR is flattened out a little bit, but still beats my hurdle, fine.
So Randolph,
George, can I ask a question here?
Yeah, go for it.
When do you decide to? I got two things. Number one, when do you decide that you're wrong and you're like, okay, I lost? Is it 5%, 10%, 20%, 25%? When you say, yeah, I got this one wrong, that's the first question. The second question, as building a portfolio, you have got to manage your exposure in various spots. So if you're buying the Qs, which I'm on Tommy's side on this, I'm not ready to buy any of that stuff. You have to be buying some materials, some energy, some utilities to balance out in the case that the growth bloom is off the rose and there's a real shift here. Because if you're setting yourself up for a 2 to 5 to 15-year year trade, it could be a lost decade in theory in your tech trade. So I just be careful about that. That's what I'm trying to say.
Yeah. So let me address the second one. First of all, I'm not setting myself up for a possible 15-year trade. My explicit forecast horizon in valuing these things as businesses is 5 to 15 years. But as I said, my average time in market is 2 to 3 years. Now, you said you got to be balancing with materials and energy and all that other stuff. Look, the time to have done that in the way I operate was 2 years ago, 3 years ago. So I have those exposures and I'm riding them, and I'm not trimming them like a fool, because I know, that is where the momentum is. So I'm always living, basically 2 to 3 years into the future on my time in market. And I'm always thinking 5 to 15 years in the future in discounting these things fundamentally as businesses that trade in the market every day. Number two, so going back to your first question, all of that stuff is laid out ex ante, and I have a process by which I audit, I pre-mortem, and then I lay out a hypothesis that is falsifiable ex ante, which means I give you the argument by which you can take apart my argument And that also is available for ex post audit as to like, how did I fuck it up? What did I get the explicit forecast wrong? Did I like do a lot of right things but just lost for wrong reasons or right reasons? There's a process to all of this in the fundamental world that I try to adhere to very assiduously.
Randolph,
No,
that's
it sounds like it. It sounds like it. Okay, you got a plan. That's
I'm
half
a
the
hair
battle
shirt
right there.
man. I'm a hair shirt caveman.
that's great. That's great. So Randolph, stay
Yeah.
up there. I'm sure you'll get some more questions.
All right, thanks, dude.
Let's just keep the panel moving here. So I want to go to Michael. I want to go to Simone, and then Michael K and K Fab. Simone, you're up. What's up?
Hi everyone. Great space as always, George. So my question was around the old text the text the tech sector. I mean, I think that there is a divergence between the mega cap that we have to see them falling, and the small and more micro cap that have been already dropped a lot. So I honestly close my short position on the QQQ and the Apple uh, on Friday. So since I think that we will have a little bit of a pullback, and I'm planning to re-enter it. But I think that there is some exception on some small and micro cap on stock, and so do you see, guys, a divergence on that between the small and micro cap on the tech sector and the mega cap?
Tommy Thornton, you want to take that?
Yep. I don't necessarily see a wide divergence. I think that you've lost the small cap, the micro cap, a lot of the unprofitable technology stocks, the Kathy Wood stocks that are illiquid, and the next shoe to fall, I think, is the mega cap. And I think that we're going to probably get a little bit more bounce, and I'd be more than happy to sell the other, half of the position I covered this morning on Qs into a bounce going, ahead of either Microsoft or Apple. And I'm very comfortable doing that. But you know what? I'll watch for that. I'm always, I'm not so bearish to be stubborn. I look for opportunities for bounces, and look, they may hold this March level, but I do think for now, but I do think that heading into the summer, I don't see those levels holding. So that's my only concern
Right.
right now. Sorry.
I appreciate that, Tommy. I mean, Simone, I think they're all. To me, it's just a race to the bottom. I think they're all going down, but that's just my 2 cents. So thanks for the question. Let's keep this moving. So I want to go to Michael K and then KFab. Hey, Michael, what's up?
Michael? Hey, George. Hey,
What's up?
hey. Just want to comment on what Randolph was saying. Obviously, I understand everyone in the room and their view on Qs and the overall market from an absolute level and everything going down eventually. But I think in the next 3 to 4 months, over the next 3 to 4 months, there's going to be the payrolls report and the CPI report. If there's any hint of a miss from these extrapolating, right? Everyone's going to extrapolate expectations. If you look at Bloomberg consensus, they always just literally the best forecast of the forecasters is what happened last month. So everyone's going to be continuing to forecast for higher CPI. Eventually, we're going to see a miss, and that could keep a little bit of a ceiling on yields, so pushing down a little bit. That's a very bullish development for stocks, and Qs can go up a lot. It's a short-term thing. It's is it an investment thesis? No, but between China slowing down even more and their problems are only going to get worse, not better. The rest of the world already in the beginning of the slowdown, and listen, there are a bunch of inflation pieces that are now decelerating. Commodities have kind of gone sideways for a few weeks now. There's a possibility, but at least we have to think there's a possibility that that's going to happen at some point. And so before we get a growth panic, an earnings collapse, earnings revisions downward, and everybody missing, which is later this year, I think you just got to keep that in mind before you get too bearish. And I think that could be big upside for a lot of the laggards. That it's crowded, it's underperformed, etc. I think it's a short-term trade, but I think we all got to keep an open mind. Think about that.
Can I lay down a quick riff on that, George?
Go for it.
All right. So I agree with that. And you kind of see that with crude today. Last time I looked midday, crude is down 5%. We've got some shorts on there. Nothing huge, but essentially, if you're long the thesis of continuing inflation, essentially you're short human innovation. And we'll get this stuff worked out. And yes, any sort of a miss to the downside on CPI is going to could light a fire on the QQQs, as people are like, but finally, what I would say is we don't need to wait for the payrolls report. If you look at the daily treasury statement, and I think it's table 2, tax receipts, which because of the calendar are unfavorable on a QTD and a MTD basis for April, shit's going crazy out there. I mean, corporate profits are up across the board. Withholdings are up. Individual proprietor withholdings. I mean, and we're talking batshit crazy, 20, 30, 40, 60% year over year stuff's going on. The economy is very hot, and I think consumption patterns are changing. And we've expressed this in our fund, from goods based and big ticket consumer discretionary to services based. Our theme is 2022 is the new summer of love. People want to get out and experience and love and embrace and see people and experience shit. And it's good. It's happening. I see it flying all over the country. I see it, man, and it's happening.
That's really interesting, Randolph. Let me ask you something. I read similar stuff that you do about the tax revenues. Is that cause you to change your views sort of materially on now we're gonna riff on interest rates and bond supply and all that kind of stuff? But do you think the budget deficit is going to come in a lot lower than people are imagining?
It certainly seems as though it is. I mean, I'm looking at the receipts and they're crazy.
Right, Michael K. Do you have any perspective on that, or is that something outside your bailiwick?
Yeah, not my wheelhouse.
Got it. Thanks for that observation, Randall. Stay up there. I'm sure.
Yeah, thanks.
So, hey George, on the cash from I want to say something about the recent tax day we had. I know about 100 people who have said to me, "Gee, I paid more taxes than I ever thought I would. I must have had a really good year 2021." And I wonder, that big tax bill, in the face of higher costs for everything, has caused people to change preferences, economic preferences. Curious. Anyone have a thought?
I don't know, Mark. That's a seemingly simple question, but I think it's a tough one. If anyone's got an insight of that, speak up. So, as a matter of fact, KFAB was going to be up next, and heat traffics and that type of stuff. So we're going to do KFAB, and then we're going to do Def Profit. So KFAB, the floor is yours. What's up, man, KFAB?
Hey, George. Just, I didn't want to interrupt, but per the prior conversation, I threw a Fred Hickey post from about a week ago up in the nest about Apple's potential exposure in Russia and Belarus, et cetera, Ukraine. So just FYI for people that were interested. My comment relates to what Randolph was talking about, more so because, George, as you know, I've been on the bailiwick of the U.S. being the ass end of the global cycle. So, I mean, if you look at leading indicators, and now we actually have a coincident indicator, economic indicator, that is now having a negative growth rate on a monthly basis in the U.S. So the U.S. has been slowing since last spring. So the idea that the U.S. economy is on fire is just, not supported by coincident data, let alone leading data. And that's within the context of Europe. I mean, who knows how bad that's in the process of getting. And China now lining up in some kind of weird dystopian whatever is going on there. So I just have a hard time. I mean, absolutely within the gilded class within the U.S., they're going to be spending this summer quite a bit. But as Lacey Hunt wrote in his quarterly last Friday, we've got 170 million people probably in this country that had their wages, their real incomes decline over the last 12 months. And that's being reflected in credit card usage now. That's being reflected in consumer sentiment. So it's this is basically a fractal of what's going on in the corporate space, where you've got the kleptocratic corporations that have tons of cash, and then you've got 30% of the market walking around like zombies that are basically functionally bankrupt, just being floated on the wave of liquidity and stimulus over the last few years. So I just wanted to lay that out.
Keith, let me ask you something, because you're a pretty sharp cookie in this area. So let's say the economy keeps slowing for all the reasons you alluded to. People, normally just equate inflation with growth, and that relationship changes a lot. It's not always stable. So how would you think about, in the context of your view the economy is slowing, and recognizing that some of the issues are just supply side related, be it energy or whatever? Okay, so how do you think about the inflation trajectory for going forward between now and the end of the year, KFAB?
Yeah, so the objective leading indicators are still pointing higher. But the problem with that is, as you alluded to, the amount of this that's gone on because of shifts in the supply curve, first because of the pandemic, and then most recently because of what's going on with the invasion and basically a declaration of global financial war, now followed by China. I wrote about this on Friday. It's like, well, what's next potentially on the supply chain side relative to, or subsidizing consumption in venues where there are shortages of goods, like we're seeing with cutting of gasoline taxes and all of the what they're doing in Europe now to try and help people pay their bills. What should happen, recession or slowdowns are inherently disinflationary, but inflation is sticky, even without these supply chain issues. So the idea that inflation is going to come down fast is probably unlikely. And I think that the risks of more, let's call it non-normal policy decisions and continued kind of disaggregation of the global system is significant, and so that's basically that's where we're at. And this I talked about with George a couple of months ago. You could see a situation where you have shortages, and whether it's in food or not necessarily in parts of the U.S. but globally. And again, this is why I keep coming back to this. This is a global cycle. And the idea that the U.S. is just going to withhold and stand up with Europe doing what it's doing, China doing what it's doing, to me, is about as sound as the arguments that the emerging markets had decoupled in early 2008.
So KFAB, I agree with all that, but I want to differentiate between. So let's say that you're right on that. Okay, let's just stipulate you're right. But given that this cycle, again, you always history rhymes, doesn't repeat. Given the extent to which some of this, so the economy slows down, housing will slow down. That's been a big source of inflation. Energy, well, you'd say, okay, less demand for oil, blah, blah, blah. But the other side of it is, crude demand is not that high beta, and also there's some supply issues there. So I would say the jury's out on oil. As a matter of fact, it's still a reasonable chance. If you're talking about a slowdown and not a outright recession, I can still see oil prices going up, believe it or not. And then agriculture and food. So where does that leave you thinking about the? I guess what I'm getting to is not, what's the economy going to do so much, where they could argue about it's a slowdown, it's a small recession, unless you can say it's a big recession, and more about interest rates, inflation, and interest rates. What's your take on inflation and interest rates, KFAB?
Well, I guess that's the big issue is how does the Fed navigate domestic priorities relative to global priorities, right? So there are signs of, I think it was Deerpoint that mentioned it earlier, of a global dollar shortage in the euro dollar market. And again, if Europe's in the midst of going into a recession, China's doing what China's doing, and this is what I've been focused on. We've now had in the last week, emerging market currencies have started to get hit for the first time. People have been talking about dollar weakness or dollar strength for months, and that actually hasn't been the case in a broad basket of emerging market currencies. And this, in the last week's the first time we've really seen a growth scare trade emerge. And that's really going to be the question: is where does the Fed prioritize domestic politics because of inflation? Because you have those 170 million people that are getting pummeled from inflation. Unemployment starts going up into a slowdown. I mean, as you've talked about, they're cornered, and I don't have a good sense about which direction they're going to go until something really breaks. Then we know what they're going to do, and credit and that kind of thing. But in the meantime, where's that strike price at? I tend to think it's still a lot lower than most people think, because of that pain point of what's going on domestically and the politics associated with it.
Thanks, Kifab. Hey, Randolph, did you want to say something?
Yeah, just going to lay down a 60-second lick here. So I'm not sure whether it was Michael or Kayfabe that made the point. They said that wages were slowing. And what I would say is I would delineate when you look at, the NIPA tables, personal income and expenditures. So compensation of employees in Q4 was up 9.6% annualized versus a year-over-year number of 9.2%. The fiscal impulse that we're seeing, negative impulse that we're seeing in the economy comes from personal current transfer receipts, which is essentially government assistance, which in normal times is largely Medicare and Social Security, but in this last cycle had these, very special, like muscular fiscal stimulus to keep us out of really a depression event. That thing slowed 19% annualized quarter over quarter in Q4, which was a negative $780 billion fiscal impulse annualized in Q4. But when you look at the real-time data, because the one guy's like, well, you got to look at the right data. Well, yeah, you do. And the one that I look at is the daily Treasury receipts. We're talking the realest of real time. What the Treasury is getting into its coffers on a daily basis, the tax receipts are going bonkers, and you can kind of see it in the compensation numbers of this BEA table. So it's 2.1 of the NIPA, National Income and Products Accounts tables. Corporate profits are going nuts, and you can see it. And yeah, are we going to decouple forever from the rest of the global economy? Probably not. But you look at savings rate, came down from like a ridiculous 16% of DPI. Q1 2021 was 20%. Q2 2020 was 26%. And so we're coming off of these really weird fiscal salients, and things are normalizing. And so we can all come to different conclusions for sure. And it takes a village to raise a child and to trade a stock in a competitive fashion or any security. But under the hood, there's some really interesting dynamics going on. Here endeth the sermon.
Thanks, Fett. Really appreciate it. Those are really, really interesting comments. Let's keep this moving. We're on 2 hours and 10 minutes. I'd like to wrap this up by 6:30 at the latest. So try to keep the questions brief. This has been a fantastic room. Again, a pitch for World Central Kitchen up in the nest. I think we've already raised $3,000 here today. So we've got a matching 2,000 from an anonymous donor, which puts us up at 5,000 for the day, and we're going to be up at $63,000. So I salute all of you. I thank all of you. This is absolutely, absolutely phenomenal. Again, it's up on the nest. Please give generously to World Central Kitchen if you got value from this room. I mean, comments from Michael, Randolph, KFAB, Newman, et cetera, et cetera. I mean, it's just an extraordinary collection of guys just trying to help each other. This is really wonderful. All right, so let's move on here. We're going to do Def Profit, and then we're going to do Wabuffo. So Def Profit, how you doing, man?
Hi, George. Thank you for the time of the group. I just want to comment on Apple. So I'm bearish on Apple, and for the very simple particular reason. So it's not about Russia, because Russia just 3.5 billion in Apple revenue, which is just peanuts. But if we look at Apple multiple, which expanded a lot due to growth of service revenues, and service revenues provide 20% of Apple sales, and I think something like 35% of gross profit. And if we decompose these service revenues, we can see that it's most part of it's Apple Store, and Apple Store is mostly 70% of that is games, and there is also a lot of cash coming from Google, which is also related to games. And games, from my perspective, is a COVID play, like Netflix. So in last earnings, management said that they expect services to decelerate, and market doesn't like deceleration. So this 27p multiple of Apple, from my perspective, is not sustainable. So the second point is that emerging markets are in deep trouble. So Sri Lanka went bankrupt, Russia, Ukraine, and I doubt that people will be eager to pay from $800 per phone to $1,000 per phone. So deceleration, from my perspective, is coming, and nobody is short in Apple. Apple is like, the crown jewel of this market, second to Tesla. So in the case when market doesn't expect deceleration and nobody is shorting, I think it's a good position to at least short their puts. So George, you saw my position in Apple, and
that's a really interesting idea. Listen, I have no insight on what the Apple numbers are going to be. I just come back to positioning and to risk reward. I mean, as you say, it's widely owned. It's been a safe haven. People have been hiding out in that name. And more importantly, if there's anything wrong with either the numbers or the guidance, it's going to be off with their heads. You're not going to have time to short the stock if they come out with anything questionable in the numbers or the guidance. And conversely, let's assume the numbers and guidance are good. I don't think it's going to go up very much. I mean, Newman, I don't know if Newman, are you still there? I mean, you look this more carefully than I do. I got to pull the chart back up, but you and I have been talking about this over the last week or two. I mean, it looks like it's got not a lot of upside, but it's got a fair bit of downside. So, Mark, if you're still there, I don't know what your take is on Apple right here, Mark. Maybe he's gone, whatever.
Hey, George.
Yeah,
I'll just add a comment. We've done tons of studies on earnings surprise as a factor, and interestingly, it doesn't really work that well, especially in large caps over time. And that would not seem intuitive, but when you dig down, you realize companies like Apple are serial beaters, and companies that are serial beaters that always keep expectations low and beat the numbers don't really get upside from it. There's massive asymmetric downside if they miss, or a company like that misses. But in general, that's I guess since 2002 Reg D, everything changed. There really hasn't been much upside buying stocks that surprise, or I should say, those that are serial beaters, which are many of the large caps, especially. So asymmetric risk to the downside, especially in this period of market, uncertainty.
So George, it's Newman. I just caught up back in here for a second. I lost you. I did look at this today from an options perspective. There was about a 4.5, just under 4.5% chance. 4.5% move implied in the Apple earnings report versus like a little more than that the last 8 or 9 times. But the only 2 times it really moved hard was when it went to the upside. And like the previous gentleman's said, the downside moves post Apple have been all muted in the last 6 of the last 8, like 2% little moves. So I looked, it's like a $5 wide bet on earnings, and I asked someone, which would you rather be short? Which would you rather be short, the upside or the downside? And everyone was like, I would not want to be short the downside. So the move in Apple is skewed pretty flat, but I don't think anyone wants to be short Apple going into earnings.
I mean, Mark.
Danger wise, I mean, like. Hold on. Did I say that backwards? I'm sorry. I might have said that backwards. Nobody wants to be short the downside. In other words, people think it can go down a lot harder than it can go up on earnings, like said before.
Got it. Okay. Yeah. Alex, what'd you want to say, Alex?
That's why exactly from that point of view, I am shorting via puts. So I bought puts like 2 days ago, and I'm double on this position, but it's small. I don't. My main position is short Germany since January. Second observation, I want to say very, very briefly about general market sentiment. So my friend, who is a tech entrepreneur from the United States, so he's like $40 million net worth. Half of this is in venture capital, and 20 million is in public markets. And he gave this money to UBS and Goldman Sachs, wealth management. And he called me just last week and said, if I can look at his portfolio. I said, what happened? He said, I wanted to sell all my positions from bonds to stocks. And my advisors told me not to do anything because in the long term, it will go up. So, and in his portfolio, he has everything from Alibaba to Robinhood, all the shit which is pumped on Twitter. So, from this observation, I can say that people don't sell yet, but they are becoming nervous because he is down 5% on his capital, which he put into the market in 2021.
So do you think he's an example? There are many more people like him who have big exposure and are getting nervous. Is that what you're saying, Alex?
Yeah, I'm saying that people are starting to get nervous, but they are not selling yet. So they're trying to call somebody to get second opinion because advisors like UBS and Goldman Sachs, they say just hold on. It's a minor correction. Everything will go up.
I like that, Alex. Stay there. It's a great observation. All right, we're going to do 2 more questions, and I think we're going to call it a night. We're going to do Hector, and then we're going to do Wabuff. Hector, what's up, man? Please unmute yourself. Hector?
Perfect. Timing was great for my question. So I'm a long-term investor. I've owned Apple and Amazon, 2 of my favorite stocks, for over 10 years. They're both in non-taxable RSP accounts in Canada. So it's just so I can sell it and I won't pay capital gains. I'll pay when I withdraw, when I retire. I've always been trained to keep these stocks forever until I see someone doing a better job than them. So as far as I'm concerned, no one makes a better product than Apple. But is that wrong? Should I be like, you know what? It's up. The Apple position is worth $1 million. It's a huge part of my portfolio. I agree with everything you guys say on the downside. There's way more downside risk short term than there is upside. But if it's a non-taxable account, do you trade it, sell some, buy back if it dips, if you still love it? Or do you just forget about it? Because I have 10, 15 more years left. What's the right thing to do when it's a non-taxable account?
Listen, predictions are, as Yogi Berra famously once said, predictions are difficult, especially about the future. I want to go back to my mentor, Peter Lynch. And the answer lies there. It's know what you own. I tend to be a numbers guy. I have no special insight as to this quarter, but I look at what's happened to Apple. I want to find it up here. I have a chart. I'm fishing for it, which shows how Apple's stock price has benefited from an enormous multiple expansion. Enormous. And, the margins actually of Apple haven't really done all that much. It's just the PE's gone crazy. So if you look at the price to sales on Apple right now, to me, and again, I'm going to cede the floor to you. You've forgotten more about Apple than I'll ever know. I'm just a tourist, but I look at the multiple expansion that Apple's undergone, and I look at the PE and the growth rate, and my vision is not colored by, oh, I hate it because I lost money shorting it, or I like it because I made money being long. Just looking at the numbers, to me, it looks pretty extended. And so, I don't know if someone else wants to weigh in here. I'm trying to find the chart. I had a particular analysis here that I had just looked at 2 days ago. And to me, the numbers, like, it looked like it jumped off the page. It looked like the rubber band had been stretched about as far as honestly, as far as it can go, but it had been stretched a long, long way. So I think, but then it gets back to know what you own. If you think that, Apple's got legs, whether it's the healthcare part or, they're gaining market share in China. I read somewhere, I think, where their market share is the highest it's been in China ever, or in a million years, blah, 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 blah. Then I defer to you. But I mean, I would just say a lot of that's in the price, given the current valuation. So I don't know. I mean, Alex, did you have any particular thoughts about the valuation of the margins of Apple? Forget about people owning it. Forget about the fact it's whatever it is, 6% of the S&P, whatever the number is. But do you have any more specific thoughts, Alex? Any more specific thoughts on Apple, Alex?
Yeah, my main thought is rate of change of growth should slow, and if rate of change of growth is slowing, then multiple should go down. That's classic from all books. And the main driver of Apple multiple was services. And services is stimulus plus COVID. So we saw what happened with Netflix. So of course, Netflix or Apple is a monopoly. That's why the greatest rent seeker in the world, Buffett, invested in Apple. But market values companies in the medium term on rate of change of gross profits. And Apple gross profits are very impacted by services. And services are very impacted by games. And games is COVID play. So that's my thesis. And that's why I own my 150 puts on Apple. And it's a small position.
Great, I appreciate that feedback. One last thing I want to just throw out there, maybe George can help with that, is the whole training where they train retail investors, buy something and own it, don't trade it. So you own it, almost like owning it forever. Is that something they've been telling us all our lives, so we can open an account, give them our money so they can take their fees forever? Do you really want to own the stock forever? Or do you just buy it and then when you hit your target, you sell it?
Yeah, I don't know how it really works, but my friend who has a friend in the bulge bracket wealth management bank, and he told me that there is an instruction not to tell clients to sell something. So if a client calls you as a wealth management account in bulge bracket bank and asks if I should sell, the management should tell him you shouldn't, because in the long term it will be fine. And it doesn't matter what position it is. It can be Apple, it can be Alibaba, it can be Robinhood. So there is huge agency problem, I think it's called, yes, in this business, I think.
Yeah, could I follow up on that, George?
Go for it.
Yeah, the wealth management industry fakes as if they're fiduciaries, and technically they're supposed to be, but they're basically asset gathering and retention businesses. So no one gets sued when everyone loses money. You only get sued if you do something different. So I had a broader question for you, Hector. You said it's about $1 million, because to me this is as much as financial planning and portfolio question as it is an Apple question. So what percentage of your liquid assets is it?
Apple right now is about 9% of my position. I lowered Amazon to about 5% this week. I'm really nervous about Amazon.
All right, so
than
you're
I
not at a
know. But yeah.
you're not at a crazy level. So
No, it's not crazy. It's just
yeah,
I think I'm retraining my brain to not want to buy and hold stocks forever. Like I invested in Nvidia a couple of years ago, and when it was at 300 and something dollars, I don't know why I didn't say, "Hey, this thing's trading at a cajillion multiple. Maybe I should sell 20% of my Nvidia." But in my mind, it's like, no, Nvidia is the best graphic chip maker in the world. It's going to continue to be that. Why would you sell it? Because I
right.
had that mindset, own it forever. But when the P ratios go that crazy, you got to take some off. That's what I've learned in the last year. Is you
Yeah,
can't hold everything forever. Even friggin' Apple, which it's so hard for me to sell because I've owned it for so long. It's giving me so much money, and I still think it's the best company in the world. But it doesn't mean the valuation is just going to keep going up for unless they announce a car or something like that. You know what I mean? So that's why I just wanted to just trying to re-educate myself. That's all.
yeah, and I'll just echo the lesson that Warren Buffett claims he learned in 1998 when he didn't sell Coke, which is there's a difference between a great company and a great stock. And there's law of large number issues. There's innovation issues in it being a technology business still. So yeah, it's not saying I'm not giving you any specific advice. It's just think about those issues and whether or not you want 9% in any stock. And if you're comfortable with that and that's Apple, that's fine. But it's just good to hear that it's not, like some people it'd be 25 or 50 or some crazy number. So just wanted
All
to make
right.
sure that wasn't.
By the way, KFAB, excellent answer. Excellent answer. And Hector, I thank you for your question because your question really taps into a much bigger issue relating to, as KFAB was saying, the role that a lot of the wealth management guys play, and also where we are in the cycle. I mean, we've had this long interrupted cycle where technology's been the place to be. Apple's had the right product. Multiples have gone up. It's become a big part of the index. It's indexation is basically a large cap momentum strategy. Blah 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 blah. All right, and who's to say this is the top on Apple? I have no idea, but this is the sort of thing that you'd expect to see at the end of a long up cycle. And if you said if I can just show you, it's pure math. If you just put Apple back on a price to sales, EV to sales ratio. I'm trying to find the chart here. I'm still having a hard time. I'm grabbing it and just plug it in and just tick the margins down a little bit. I mean, you could have Apple down 50%, no problem, no problem. So it really, but going back to Alex's point, it gets to the growth rate, and growth is slowing, and so to have it trading on like its highest price to sales. Don't hold me to this, I may be off a little bit, but to have it trading at its highest price to sales ratio or close to it at the very time growth is slowing, like to me, that just doesn't make any sense. So again, I can't tell you what to do. You know more about the company than I do. But from the cheap seats and to Alex's point about growth rates accelerating and decelerating, and then KFAB's point about law of large numbers, and looking at the fact that it's on a price to sales of 7, and you look at that relative to the long-term average. I mean, to me, it's just not my cup of tea. I wish you a lot of luck with the position, and again, I can't, and I'm not telling you what to do. I'm just I'm just trying to explain you a way to think about it. That's all.
No, that's fantastic. Thank you guys, everybody. I know this is all just shooting the shit and getting information and everybody learning. So I definitely appreciate that, and keep doing the spaces, George. You're doing a fantastic job. Thank you.
Thank you, Hector. All right, we're going to go to, hold on. All right, we got 2 left, and that's going to be it. We're going to do, Oil God, I'm going to save you for last. We're going to do John Richards first, and then Oil God. Hey, John, what's up? John, unmute yourself.
Hi, can you hear me?
Yeah, John, what's up? We hear you. Go ahead.
So my question was around SPX. So I've been trading SPX for the past few months, and I wanted to know. I feel that the market is definitely very bearish, and in June or July, it's probably going to go below 4,000. So, what is the best trading strategy to sort of, hedge yourself? Or
All right. So, John, have you? How long have you been in the room, John?
20 minutes.
Okay. I urge you. I'm sorry to do this to you, but I want to be fair to the 600 people who are in the room. We already covered this, so I'm going to ask you to go listen to the replay because it's just not fair to everybody else in the room.
No worries.
Yeah. Thank you for your question. All right, Oil God, last but not least, what's up, my friend?
All right, thank you, George. I just wanted to say you've done a great job on these spaces. Everybody should give you a big kudos and hats off for raising money and bringing in all these all-star people. And I don't know why you left, me in the recycling bin here to speak last. I definitely don't deserve it. But I just wanted to say anything that requires raw materials and innovation, I would stay very clear of. Not because Apple hasn't proven itself, and I don't want to pick on Apple because anybody who's made seven-figure gain deserves praise for sticking with it. And obviously, you had the right trade. It was a fantastic company. It's arguably not even a consumer discretionary anymore. It's a consumer staple. But when you have the everyday person struggling to pay their heat bill, the gas bill, the now mortgage or rent, the lease if they're in a business, impossible to keep employees, these are very, very luxury items here in the Western world. And it reminds me of a friend of mine telling me he came back from Arizona. I believe he was in Scottsdale or one of these places. And there was this giant citywide development. And he had asked the Uber driver what this was. And the Uber driver was saying it's going to become America's largest chip processing facility. And the problem with it is it wasn't even close to being finished because it required, I think, a H2O contract for the Colorado River that they couldn't get negotiated, or, I don't even know if the Colorado River has that kind of water in it, to get it over to Arizona. And so this is so far out there. And as we're all feeling geopolitically, the world is unwinding from some cooperative sort of globalization standpoint. And I think, George, you've had many spaces where we're all seeing the price of things go out of control to the point that we've never seen it. And when I think of iPads, iWatches, all these things that have inputs and require people to spend thousands of dollars to upgrade, I believe that the best days are behind the company. And I just want to share that.
So if someone could please, I'm going to tweet something out right now. And if someone can please, and Oil God, if you could please do this, I just tweeted this out. I found the chart I was looking for. Albert Laporta had a fantastic chart, and I just tweeted it out. And, we're all numbers guys in the end if we're doing our work. So Oil God, could I ask you please a favor? Because one day you're going to teach me how to put this stuff up in the net. Can you please take the tweet I just sent out and throw it up in the nest? Because that will answer the question. And while you're doing that, there's a basically what Albert shows here. There's a long-term 30-year chart of the stock, and you look at the price to sales or the EV to sales of Apple, and the EV to sales is 25% higher than its 2007 peak, and 177% higher than at the 2000 peak. Operating margins peaked in 2012. All right, so operating margins have gone nowhere for 10 years. The PE has tripled in the last 10 years. So when you just look at the numbers, and oh God, if you can throw that up in the nest, if you see the tweet, it's pretty stark. Like, there's no freaking way. I mean, for my money, buying a stock on 7 times revenue, where it's and that's triple what it was at 2000 peak, or 25% higher than 2007 peak. Forget about margins going down. Like, to me, that just doesn't sound like a very good value proposition. But again, I don't know. I have no edge on this company whatsoever. So I'm just
George, I just want to say I tried to. I think you have to be a host to put things up in the nest. Maybe I'm wrong.
No, you got it. It worked. It worked. We're gonna go offline. You're gonna give me a tutorial about how to do this. It's up there. I don't know if you can see it, but you got it up there.
Got a row one, George. I don't know about this nest idea, but thank you for this.
No, it's up. All right. So So listen. With that, it's been a fantastic room. We've been at 2.5 hours. Chris Verrone gave a tour de force. I would again implore each and every one of you, if you've got value from this room, please pay it forward. Please give to those in dire need. World Central Kitchen is doing God's work in the Ukraine. We broke through the 60,000 barrier today. Between the 3,000 that the room put up, there's going to be a 2,000 matches, 5,000. But everyone gives to their means. If you're
a student, have very little money, $10 is fine. If you're one of the deep pockets in this room, you've got millions, contribute 500, 1,000. Some have given as much as 5,000. So give to your means. And so this is fantastic. We're helping each other and we're learning from each other, and we're also making a difference. So just FYI, the next won't be another space this week. There'll be one on the weekend. That's only because Thursday at 3:30 there'll be a live stream of the keynote speech from the CMT conference given by John Roque and yours truly. That will be live. It's usually a closed shop. It's for members only, but the CMT folks, they've agreed to sponsor it, and we're gonna have a free live stream, which will be available. I'm not sure it's gonna be on a YouTube channel or on Twitter. Maybe the YouTube channel. I don't really know how this works yet. But at any rate, I want to thank all of you for coming. This has been a fantastic session. And preview coming attractions. I don't know what we're doing this coming week. I haven't set that up yet. But on Wednesday, I think it's Wednesday, May 4, whatever May 4th is, we're having Professor Peter Atwater from University of Maryland. William and Mary. He's a behavioral psychologist, and he's going to be talking about investor behavior. And if you haven't heard him speak before, you're not going to want to miss this. It's going to be. Yeah, it's Wednesday, May 4. He's going to be talking about sort of the crazy behaviors, people flushing down flushing down their money down the toilet in NFTs or AMC or stupid SPAC stocks. Why do people do this? And he's got some very interesting theories. When people, I'll just give you a sneak preview. When people start to lose hope and they have this sort of dystopian view of the world, they do crazy things. And so Peter's a really, really interesting speaker. Again, that's going to be on May 4. So in any event. All right, listen, this has been fantastic. Again, please give generously to World Central Kitchen. This is wonderful. We've got tons and tons of great rooms coming up. And again, I think we have the best rooms, the best spaces on Twitter, in part because we have the best audiences. We have the best questions, which gives to the best conversations. So again, thanks to all of you. Good night and take care. Bye-bye.